AI remains the main story for good reason.
The CapEx continues unabated.
The broader tech ecosystem, that resilience, I think, is fragile.
It's sort of a tug of war that goes on, but from a demand perspective, it's accelerating, not decelerating.
What's becoming more and more important is that diversification away from AI risk.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, stocks advance. Equity futures pushing higher following blowout numbers from Nvidia. The world's biggest company forecasting a revenue surge into 28 after breaking back into China, selling a small number of H200 chips. The stock higher in the pre-market.
The number that was important for this market is 70%. That's what they see for their next year's revenue. But perhaps the more important number, John, is 100%. That's what Nvidia said their revenue for next year would have been if they were not supply constrained. The CFO says that that's why we're spending so much. So it's a great way to shut the bulls out, say our circular financing is fine because our growth is enabled by it.
You know that classic interview question, what are your weaknesses? And you're like, I'm supply constrained. It's not really a weakness, is it?
No, it's like saying, oh, I just work too hard. That's my problem. I'm a perfectionist. That's my issue. But it worked for them. I mean, shares are up in the pre-market, and if the gain holds through today, it would be the first gain on an earnings reaction day in 5 quarters. They haven't had that in some time. Stock
is up at the pre-market by 7%. You've got a market looking for 40% revenue growth. You put up a forecast of 70. You're knocking it out of the park. On real potential weaknesses, gross margins. There was a moment where there was some concern around this story before we got that revenue outlook.
It always feels so silly to say we're disappointed by a 72% gross margin, but that is what we're dealing with. The expectation had been higher. To be fair, they say that things will get better in the following year. And again, this comes back to the idea that they are spending a lot in order to help their suppliers get through some of these issues, but memory still a constraint.
Let's turn to the bond market as well. 2s, 10s and 30s, yields bleeding high this morning. We're up by 2 basis points. 10s at 466, 30s around 520, beginning today in Jackson Hole, Wyoming, the annual Fed get-together. The man himself, Kevin Warsh, speaking tomorrow morning. Look out for that special coverage right here on Bloomberg TV. Is this Fed losing patience or losing confidence? Are committee members losing patience after being above target for so long, or losing confidence in the man at the top of the committee?
And is this a market that also shares that loss in confidence? And what can he do in order to restore it if the second problem is the one that both the committee members in this market are grappling with? There is no clear roadmap to restoring credibility. There's no clear way to do that, save for him coming out and committing that they will be fighting inflation. And how do you do that without delivering forward guidance, which Chair Warsh has explicitly said that he will not be doing?
We've got just a little bit more data. We've got jobless claims later this morning at 8:30 Eastern Time. Into next month, September just around the corner. One more payrolls report on September 4th. Then a week later, we'll have a CPI report. Those two reads setting the stage for a meeting mid-September for the Federal Reserve and Kevin Warsh. Coming up this hour, we'll catch up with Kennon of Clear Harbor Asset Management, with earnings fueling the equity rally. Angelo Zino of CFRA breaking down Nvidia's blockbuster sales guidance, and Torsten Slok of Apollo and why he's expecting interest rates to stay higher for longer. We begin this hour with stocks edging higher as Nvidia earnings reignites the tech trade. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, they crushed it. That outlook, where has that come from for a company this big, putting up this much growth already? How do you generate 70% revenue growth?
Well, we were anticipating, how a company like SpaceX, which is ramping up their CapEx ambitions going into next year and the back half of the year, could contribute to Nvidia sales. And to my mind, when you are a $400 billion business and guiding for 70% growth, and that's conservative, you need to have somebody big. So I think it's a combination of SpaceX and NeoClouds really ramping up big time in terms of, the NVIDIA ecosystem that they want to create. And we can talk about, the backstops and the balance sheet that NVIDIA is using. But at the end of the day, the demand is there for compute, and NVIDIA wants to make sure that they have a large, customer base to serve rather than just the 3 or 4 hyperscalers. That was the case so far.
Mandeep, there were some weak spots. Let's talk about them. Gross margins, that got a lot of attention. Vital Knowledge in our street wrap this morning pointing out that days to sales outstanding really started to move in the wrong direction as well, maybe extending longer payment terms for customers too. Mandeep, that is a sign of weakness. If you have that strength right now, you'd be able to pass on those higher costs. Are you seeing evidence of competition creep into the story at Nvidia?
Well, they talked about absorbing some of the costs. And look, memory prices have gone up 3-4x. So from that perspective, Nvidia increasing prices by 20% is not the same amount as, what their component costs are going up. And I think it's for a good reason. They want that stickiness so that, the next time there is a new architecture, those customers will upgrade without thinking about developing their own chips. And it sounds like all the accelerator chips that we talk about, the custom ASICs, really aren't making a dent in terms of impacting NVIDIA's growth, at least for now and through 2027, given they've guided, for that strong growth number.
Mandeep, it's good to see you. As always, buddy, thank you. Mandeep Singh there of Bloomberg Intelligence. The stock in the pre-market higher by 7%, makes up about 8% of the Nasdaq 100. Clear and obvious outperformance on the Nasdaq this morning. That particular index, futures, higher by more than 1%. Here's the view on Wall Street this morning. Kennon of Clear Harbor Asset Management writing, expect AI and the extraordinary capital investment associated with the data center build-out to increasingly enter the Fed's discussion. Aaron joins us now for more. Aaron, welcome to the program. Let's build on that. Is that a story the Fed strips out or has to bake in and begin to react to?
We'll have to see, Jonathan. I mean, we're going to hear from Fed Chair Warsh on Friday, and maybe we'll be able to read some tea leaves on how they're thinking about the September meeting. But certainly, AI is a big part of their story and their contemplation, because in the short term, we're looking at inflationary pressures that are impacting ultimately consumers, or at least concerning consumers, and there's huge political consequence to that. In the long term, there's a hope that AI will generate significant productivity gains, but it could also disintermediate employment. So there's a challenge there for the Fed as they speak both to the market as well as to the American people at both the FOMC level as well as out in Jackson Hole.
Aaron, look at the runway for demand right now. The call from Nvidia, they're telling you this is going to continue, even with memory costs going to the moon, through the roof. Aaron, with that, you've got a market at the moment, you've got a whole AI ecosystem that is arguably increasingly rate insensitive, not rate sensitive. What can this Federal Reserve do about any of that?
Yeah, I think it's challenging, which is probably why they're going to, continue to sort of focus perhaps more in a more traditional manner on the inflationary data, and perhaps, look through the rearview mirror. But as Fed Chair Warsh has indicated, sort of current data is more important than trying to predict future data. So it's going to be a challenge. I mean, the last couple of weeks, we've seen both disinflationary pressures from PPI and CPI, and then just earlier this week with PCE, we saw a little bit of reacceleration concern there. And then on the employment front, of course, the last print was a little weaker than the prior few prints. And so I think the Fed is sort of in a holding pattern here, which is probably why the market may be correct if they don't do anything in September, and that they contemplate a move in December. So we'll have to see. Certainly, tomorrow will be quite interesting from that perspective.
Well, things like the impact of productivity, Aaron, because of AI, aren't immediately clear yet as to what impact that'll have on the economy. What is clear now is the enormous wealth that's being created from all of this. There are stories of hundreds of houses in San Francisco going for $1 million over asking prices. The cars at the Monterey Car Show doubling in price at auctions that they were a year ago. Aaron, what about the wealth effect? How should policymakers be thinking about this enormous amount that all of a sudden consumers have in terms of firepower?
Yeah, I mean, it's the tale of two economies. And, certainly if you do not own financial assets in the midst of this period of a great boom, both on AI, but just the broader equity market since 2022, you've been left out in the cold. You've experienced higher interest rates on your cars. If you have a variable mortgage, you've experienced higher interest rates on that. Most people in the lower quartile don't have a mortgage. And so it's been, I think, really challenging. Credit card defaults have at the lower quartile have actually increased, and their lines have been cut in some cases. And of course, prime rates on credit cards have been elevated. So you have a real challenge, which is feeding into the November elections and the narrative around data centers, not in my backyard, inflation. ISM manufacturing data has actually been accelerating, but we're not seeing significant improvement on the employment side as it pertains to that growth. So what does that mean? Higher margins for corporations, and perhaps less of a benefit from an employment perspective going forward. At least that's the concern right now at a policy level.
It's a hard one to address, the two-speed economy that you're talking about, Aaron. So what can they do to address it when moving interest rates is something of a sledgehammer to this entire economy?
I think in some important sense, particularly now that Secretary Bessent has weighed in on the long end, just speaking about the importance of Fed independence, for Fed Chair Warsh to convey that there is a new sheriff in town, but there's an FOMC committee as a whole that's trying to work together, may not always agree, but is independent from the political noise of the moment. I think that's going to be critically important, and perhaps we're going to hear from Fed Chair Warsh on that point as well tomorrow.
Aaron, slightly controversial. I brought up this point yesterday. They're losing patience. You can see that in some of the speeches we've seen more recently, losing patience after missing their target for so long, some 5+ years. It also appears, Aaron, to some extent, they're losing confidence in the person leading them. And I think you can point out several policymakers on that committee who said very little about missing this target for so long under Chairman Powell and are saying a lot more under Chairman Warsh. What do you make of that change?
Yeah, I mean, I observe them all, and I try to observe them all when they put posts out, and sometimes they're videos, they're on LinkedIn. You know, Beth Hammock, who I respect, but is sometimes, you know, pushing back on Fed Chair's Warsh reticence to perhaps raise rates, for example. And I don't know. I guess if there's a new leader at the Fed, there's also an element of signaling not just to the market but to the Fed Chair himself that no, we are voting members. Yes, you're the sheriff, but ultimately, this is a committee, and it requires multiple people to decide on where policy is going, and we want to let you know that we have strong views. I mean, to say that they don't have trust in this Fed chair because inflation has been incrementally elevated above the target since he's been at the helm, but then not see them critique Fed Chair Powell for such a long period of time, I find that unfair to this current Fed Chair. And I think there's probably a level of professionalism within the FOMC that will prevail, and this may be more of a narrative that we're worried about.
Aaron, thank you, sir. Appreciate it. Aaron Kennon there of Clear Harbor Asset Management. This institution has been under tremendous pressure now for 2 years, let's say 18 months. Tremendous pressure to reduce interest rates. All it's done, the outcome of which has just been to put even more power in individual policymakers' hands. I think Jim Bianco of Bianco Research has written about this extensively, that we've gone from one man leading an institution to 12 individuals with equal power across the committee.
It's a chicken or the egg problem, John, because yes, you have Fed FOMC members speaking up more about this with Kevin Warsh now as the chair. But are they simply reacting to how the markets reacted to Kevin Warsh? Are they reacting to him, or are they trying to express themselves in a way that helps bring in long-term rates and gives more credibility to the Fed? It's difficult to kind of see which is leading here, but the timing is notable either way.
The yields this morning on 30s up 2 basis points. Your 30-year still 520, around 520 at 519. TK and Bramo on the ground in Jackson Hole, Wyoming. They'll have some special coverage for you tomorrow morning from 9 a.m. Eastern Time. In the meantime, let's keep you up to speed on our news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Nvidia shares up more than 7% in the pre-market. The AI giant topping earnings expectations and delivering a bullish sales outlook. Nvidia projecting to grow revenue by approximately 70% in fiscal 2028, nearly double what the street was expecting. Meta agreeing to pay up to $18 billion in settlements with U.S. states over social media claims. The deal also calling for new guardrails on Facebook and on Instagram, including limits on how long young Americans can scroll. Some payments depend on other social media companies adopting similar changes and payouts. And Fed Governor Lisa Cook again denying allegations of mortgage fraud as President Donald Trump renews his efforts to remove her from her post. Cook's attorney sending a letter to the White House yesterday calling the allegations, quote, unfounded and untrue. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, Nvidia powering the AI boom.
Right now, you don't really worry about the semiconductor results.
They see a path towards doubling the revenues next year.
Very, very good news for the memory makers.
We were looking for a guide of something like 40%. We got 70, which is a ridiculous number for a company this large. Angelo Zino of CFRA joins us next, live from New York City this morning. Good morning. Kicking off later on this morning, in the next hour or so, the annual Economic Policy Symposium of the Kansas City Federal Reserve. We'll catch up with the Kansas City Fed President a little bit later. We'll do that at 7:30 Eastern Time. We'll play out some of our conversation over in Jackson Hole. Ahead of that, we've got some economic data as well. Jobless claims at 8:30 Eastern Time into tomorrow. U.S. consumer sentiment into the weekend. Then the main event, the man himself, Kevin Warsh, Chairman of the Federal Reserve, speaking tomorrow morning. Equity futures into that, your scores look like this. Equity futures pushing higher up by 0.4%. Outperformance on the Nasdaq higher by 1%. 8% of that index, this stock right here. Nvidia in the pre-market absolutely flying. Nvidia higher by more than 7%. Danny, we'll talk more about these earnings, but usually when you come off a bigger and bigger base, it gets harder and harder to put up numbers this large.
And that has been the case for Nvidia because the past 5 quarters, the numbers weren't large enough. It was a disappointment, but they come in 70%. Not only was that not what they expected, Nvidia doesn't do that. They don't give forward guidance to that degree. It's the first quarter they have ever done that, underscoring their confidence.
Up 7% in the pre-market, under surveillance this morning. Nvidia powering the AI boom.
Right now, you don't really worry about the semiconductor results.
If they would be able to get more supply, they see a path towards doubling the revenues next year.
Very, very good news for the memory makers and the latent demand for AI. It's really down to whether these LMM models are actually going to be as profitable as they originally had planned.
So here's the latest this morning. Nvidia's bullish sales outlook accelerating confidence in the tech trade. The chip maker predicting approximately 70% revenue growth into 28. The CEO, Jensen Huang, touting the AI infrastructure build-out, saying Vera Rubin chip production is at full steam. Angelo Zino of CFRA maintaining a strong buy rating on the tech giant, writing Nvidia is entering a new phase of platform-driven growth. Angelo joins us now for more. Angelo, that is quite a number. Danny and I have spent some time on that already this morning, and welcome to the programme. Walk us through how unusual it is to see a company get this big, come off such a large base and still predict growth of numbers like 70%.
Yeah, John, and thanks for having me. I would say, listen, this is Nvidia trying to make a statement here in terms of providing that calendar 27 outlook. And maybe to your point, this is a company that everyone was looking at mid-40s growth for next year, guiding to 70% plus. And I'd say there's really kind of 4 drivers here that's driving at least that kind of pent up or relative increase from the 45 to the 70%. I would say one, it's greater than expected demand from the hyperscalers or spending. I think probably what Nvidia guided in terms of the big 5 at 1.3 trillion next year, about 200 billion or so above what we were actually anticipating. I'd say 2, you've got the pricing boost as these kind of component prices go higher. Nvidia is going to pass that on to the actual end customer, and that probably wasn't fully baked in terms of our estimates. The content growth story number 3, that is something that it was really the crux of our strong buy recommendation, and that is actually much more powerful than we previously envisioned in terms of now getting $40 billion per gig in a data center. And then finally, I think really important is what's happening on the financing side. Nvidia essentially getting all that free cash flow, and they're just deploying more and more capital back into the system, and they're finding new innovative ways, financing structures out there to really power some of these neo clouds and SpaceX. So I think that's really kind of what's driving the upside here.
Angelo, if you had to rank those drivers, those individual drivers, which drivers do you have more confidence in? Which drivers do you have less confidence in?
The one I have the most confidence in is the content story. And again, it's why we have our strong buy recommendation as we look here to the next 2 iterations, right? Not only via Rubin here, but as you go to Rubin Ultra late next year, as long as that rolls out in time, because that is a new architecture change. And then as you go into Feynman into 2028, we remain very, very bullish in terms of that content growth story going into the next 2 years. I'd say maybe the one you gotta have to maybe keep a little bit of an eye out on is kind of the financing structures out there, and to what degree do we hit certain limitations to that over the next couple of quarters.
Meanwhile, the Bank of Nvidia is still spending. This is something the CFO addressed directly, Colette Kress, on the call, saying that the majority of the spending and the financing that we have been doing, she calls it, is a very important thing called supply. Does 70% guide for next year, does that quiet the critics on the spending that they're doing?
I don't know if it quiets the critics here. I mean, listen, the one that number clearly increases the execution risk for the company. But yeah, you kind of think about what they're doing here, how they're doing it. I think obviously Nvidia is leveraging their financial power, their size here to keep that competitive advantage. It's no longer just what they've done on the software side with CUDA. It's now kind of that sheer size that they have. So I don't know if it necessarily quiets the critics or necessarily reduces the risk as we kind of go into 28 and beyond. But that being said, I think you've got to give the company the benefit of the doubt. I think, at this point in time, it just continues to be, what does that demand trajectory look like over the next couple of quarters? And as we get this new supply coming online, if that demand, if it translates to significantly higher demand and adoption, this is a name that could potentially continue to work here for years.
Angelo, when Nvidia first reported, shares were down in the post-market, and probably part of that had to do with what they reported on margins, a disappointing guide for where we go from quarters from here. We are in this strange dynamic where the cost of AI itself, because of open source models, has started to plummet, while the cost of building the ecosystem itself continues to be astronomically expensive because of constraints like memory. Is there necessarily tension in those two things?
I think that's a great question. I think there's some tension, but what I would say is at this point in time, it's all about what you build above the LLM layer, right? It's all about the application side. It's what these LLM providers do in terms of what they create on top of that, as well as what the rest of the ecosystem does in terms of what they create at the application layer. So you would suspect that over time, there's going to be significant growth on the volume side of things, and that'll help. And obviously, the overall economics of what Nvidia and Jensen here is doing in terms of these next gen servers will continue to kind of reduce that token cost per watt. So the dynamics, the economics of all this still makes sense. But that application layer is going to be extremely important for a number of reasons.
Is there a little hint, Angelo, that competition is starting to creep in? Just a little bit for this company?
I think the competitive pressures are absolutely rising. But if you kind of look at what Nvidia is trying to do here, right? I mean, in trying to empower those neoclouds, what they're doing in terms of those financing structures, trying to kind of broaden out, diversify that customer base is really key here for Nvidia, because we know these hyperscalers will continue to roll out their own kind of internal chips. So Nvidia really needs to rely on those neoclouds, because the neoclouds are going to continue to need Nvidia in the foreseeable future. And having Musk now on Jensen's side probably goes a long way in terms of supporting that growth trajectory, at least in 2027.
Yeah, Angelo, thank you. Angelo Zino there of CFRA. The stock is up in a pre-market by close to 7%. Yesterday morning, the morning that we thought we'd be having this morning, is to talk about the prospect of deceleration, competition. There was a whisper of maybe capital returns to help support the stock. That's not the conversation we're having at all this Thursday morning.
No, it's huge growth. Competition's not a problem. Neither are supply constraints, because we're spending to fix the problem.
The stock is absolutely flying. Futures doing better too. Up next, we'll catch up with Professor Stuart Benjamin of the Duke School of Law on how Meta's historic settlement creates some challenges for competitors. We have been on a choppy road to nowhere on the S&P 500, just staying within 2% of all-time highs on the S&P. It's a bounce this morning, up by 0.4, up by 1% on the Nasdaq. Nvidia making up more than 7% of the S&P, more than 8% of the Nasdaq, contributing to these gains on both the S&P 500 and on the tech-heavy Nasdaq 100. In the bond market, 2s, 10s and 30s. More data later. Jobless claims at 8:30 Eastern Time. Tomorrow, the man himself, Kevin Warsh, addressing Jackson Hole, Wyoming. Look out for all of that. Look out for this too. $44 billion of 7-year notes coming to market a little bit later on this afternoon. More than 1 week since Besson announced some verbal intervention for the long end of the curve. The belly of the curve, 7s. We've had some issues with 7-year auctions in years gone by. It's one to watch later this afternoon.
The problem for this market is we just got through one major catalyst in Nvidia, and that helped support us. And now what is the catalyst from here? It's hard to point to anything besides macro, because so many people have said we can ignore what yields are doing because earnings are growing at a pace of 30%. What happens when we price that in, we're done with earnings, and equity markets have to face the cold reality of the volatility in yields?
The 10s this morning at 467, 3 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Nvidia bucking the trend that we've seen in the past quarters. The shares looking like they're going to open higher after results up nearly 7%, and that is helping to lift the entire AI trade. And it really comes down to the number that you guys all have been talking about this morning, which is revenue can grow 70% next year. And listening to the call, Wang said how unusual that is. They have never guided that far out on revenue before, but he said that with customers and suppliers committing so much, he wants everyone to be on the same page. Meanwhile, cybersecurity stocks are getting a major boost this morning with Okta, CrowdStrike, both higher. Both have had huge runs this year, with Okta up about 55% heading into the print. CrowdStrike up more than 60%, and the demand is because AI is also becoming a problem, as we saw with the OpenAI Hugging Face incidents over at Anthropic and Meta. So it's becoming all the more real, and that is translating into more spending for these names. And unlike cybersecurity software, traditional software has not been so hot, with Salesforce having been down 20% year to date heading into this report. But as you can see, it's starting to recover some of that after it raised its outlook as its own AI tools gain popularity. And if you can't beat them, join them. It is also deepening its ties with Anthropic, letting people access Salesforce through Claude. John?
Benny are feeling good, no doubt. Yahara, thank you. The stock is up in the pre-market by 11%. On our radar this morning, Nvidia jumping in the pre-market following a blowout earnings report. The AI giant projecting to grow revenue by approximately 70% into 28, nearly double what the street was expecting. Elsewhere, crude shipments from Kuwait and Qatar helping to keep global prices in check. Traders telling us here at Bloomberg the two countries have increased oil volumes through the Strait of Hormuz to about 70% of pre-war levels. And finally, central bankers gathering in Jackson Hole, focusing on inflation and the prospect of higher borrowing costs, upward price pressures from the Iran war and the AI boom, pushing some central banks to raise rates, with more expected to follow.
The huge tension, which has been said for this Jackson Hole, it's the Fed in a chair that is in deep need of doing something to restore credibility, especially if they want to achieve their aim of keeping long end rates down. The issue is that this is a chair who wants to return to times when the Fed didn't speak as much. If you look at pre-financial crisis Jackson Hole, people were not talking. It was big picture ideas. It was purely academic. Well, he tried to return Jackson Hole to that, where you don't announce policy pivots. You just talk about big, heady ideas.
The less he speaks, the more important the speeches are from elsewhere.
Yeah.
That's the problem. We outsource guidance to everybody else. The last 24 hours has been pretty interesting. Let's talk about the data. The PCE data yesterday, we were this close to having a really different conversation. Got rounded down to 0.2. It could have been rounded up to 0.3. Are they the kind of margins we're talking about now to keep rate hike bets alive next month?
There's plenty of commentary out there. I was looking at Omar Sharif from Inflation Insight saying, yeah, you could hike based on this data. It wasn't just that. Consumption data and GDP figures were also stronger. It does show this contrast where you can pick your own narrative, but for a Fed, it's still uncomfortable, and it's still uncomfortable considering the market needs some sort of clarity from them that they are committed to taming inflation.
I think Omar called it the hike zone. We're in the hike zone into September. Let's talk about tech and Meta. Meta down in the pre-market by 0.4%. Meta agreeing to pay up to $18 billion in a landmark settlement.
This is a major breakthrough because when it comes to protecting our children's mental health, there is no time to lose.
It has always been our goal to make sure that every platform protects children in the same way that Meta is going to be protecting children.
The agreement requiring Meta to put new guardrails on its platforms, including time limits for younger users. A portion of the settlement is dependent on competitors like TikTok and YouTube agreeing to play by the same rules. Professor Stuart Benjamin of the Duke School of Law writing, this settlement is about Meta's bottom line and in particular their competitive position. Minors use YouTube the most, followed by TikTok, so they have more to lose than Meta does. Stuart joins us now for more. Professor, welcome to the programme. Why did they settle? Sure. And as you indicated, why didn't they settle earlier?
I think that's the most interesting question. I don't think anything that happened in the trial was a surprise to them. In fact, as you may know, in pretrial discovery, they already turned over all of the information that was basically being used against them. So they knew what was coming. This was all could have been prefigured pretty accurately. My guess is what happened is that they saw they were getting into cigarette company land in terms of the public reaction to them, and that this motivated them to settle. If I might add, I think that having settled now, I'm guessing they wish they had settled 2 weeks ago, because all they've gotten out is a couple of weeks of bad publicity and really not much to show for it.
Professor, what kind of litigation exposure still remains? There are some outstanding issues. And what kind of read would you gauge from their approach to this litigation for their approach to the other litigation?
Right, but these were the big cases, because this was the equivalent of the cigarette litigation, where you have the states going after you, being able to sue essentially on behalf of all of the citizens of the states. So there are still going to be a bunch of other smaller lawsuits that will be brought. They'll have to deal with, but those are going to be in the millions, not the billions, and probably not the high billions. And a lot of the oomph, to use a technical term, in those later cases is going to be taken away now that Meta has changed its practices. It doesn't actually change legally the harms that minors might have had in previous years. I just think it's going to have an impact on juries.
Professor, as you pointed out, the competitive landscape to this is really interesting. Of the $18 billion, only $12.7 billion they have to pay out. The rest is contingent on TikTok and YouTube adopting very similar measures. Why would it be structured this way? And why would both the states and Meta go along with having this kind of competitive clause in this decision, in this settlement?
It's a great question. For Meta, it's easy, as you saw in the write-up that I had. Meta is the third most popular of these platforms. YouTube far and away the most popular among minors, then TikTok, then Meta. So from their standpoint, they love to be able to say it's not just the other 5 billion. It's we will have a 1 hour cap instead of a 2 hour cap on limits, only if our competitors have similar caps. Well, that hurts their competitors more than it hurts them. So then the interesting question is, why did the states agree to it? My guess is from the states' standpoint, this was icing on the cake. They were already getting, more than $12 billion from Meta. If this puts pressure on TikTok and YouTube, all the better from the state's perspective. You're worried about protecting children. Let's do. We are now aligned in Meta in having an interest in pushing the Meta's competitors to have similar limits.
Well, the way Meta has interpreted this is to say not that they got caught creating a product that was addictive for teens, but instead saying, look at us, we are now the standard bearer in terms of delivering a product for teens that is now safe, and our competitors, they should follow suit. Professor, you mentioned that they wish they had settled this 2 weeks ago for PR's sake. Do you think that the cleanup they're doing now is enough to help restore their public image?
It's a great question, because I do think that they've been getting just hammered in the press. And so I think this will probably help a lot. Again, I think if they could have been seen as doing this willingly before the drip drop in the litigation, I frankly think they would have been in a stronger position.
Can they do it for adults too, Danny? Can we make that happen? Just ban the unlimited doom scrolling.
The problem is that there's stuff on your phone that you can make to limit your time on social media. Who uses that?
I use that.
Do you? Good for you.
Honestly, I've said this repeatedly on this programme. The algo on X has got so good that some of the video content started with the World Cup and a few other stories. I just found it so sticky through summer that I had to limit my use of X over the summer.
It's bad. It knows what's on your mind and dives in it. Like, I'll be in a place and look for restaurants in that place, and all of a sudden my entire Instagram is just that place and where to go.
It's listening to you, Danny,
It's
without a
terrifying.
doubt. Stuart, it's good to see you. Thank you, sir. Stuart Benjamin there of the Duke School of Law. Professor, thank you very much. The end of unlimited doom scrolling, I hope, for the kids, because it's certainly a whole lot healthier.
Yeah, well, also, I mean, if I can let my mind go in the dark, scary place, AI is going to take a lot of jobs. People have more free time.
Oh, don't, Danny.
They'll just be
No,
doom scrolling
no.
based on AI. I doom scroll my own brain. I don't even need social media.
That
Look
can't
at
be
that.
the future of society. Futures this morning on the Nasdaq up by about 1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Russia is reportedly preparing to escalate its attacks on Ukraine as negotiations have effectively collapsed. Sources telling us here at Bloomberg, Putin may ramp up conventional ballistic missile attacks on Kyiv, as well as other major infrastructure across Ukraine. At least 165 people are dead and at least 1,300 people missing after a flash flood devastated a Nepalese valley near the Chinese border. Geological assessments finding Wednesday's flood was caused by a collapsing glacier in the Himalayan region. Rescue efforts are underway. The US government is investigating Singapore-based Apex Logistics for its suspected role in smuggling Nvidia chips to China. Authorities are looking into whether Apex transported systems made by Supermicro, which contain Nvidia chips, through multiple countries to China, often using false documentation. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour in about 30 minutes' time. If you're just joining us, welcome to the programme. A better tone this morning. Equities doing OK, up by 0.4%, supported by the tech trade, supported by Nvidia. Nvidia in the pre-market higher by around 7% over the last hour or so. Up next on the programme, setting the stage for Jackson Hole.
All eyes are going to be on Warsh on Friday.
Will Kevin Warsh say that we have a fiscal issue that's driving the inflation side?
Broadening out the inflation view would be useful.
That conversation up next with Torsten Slok of Apollo, live from New York City. You're watching Bloomberg TV. Nvidia in the pre-market higher by 7% this morning, up by 7.2 in early trading, beating estimates for 16 consecutive quarters, looking for revenue growth of 40%. They guide you to 70. Absolutely crushing expectations, giving the equity market more broadly a lift on the S&P 500. We look like this morning, higher by 0.4 on the Nasdaq 100, up by 1 full percentage point. Attention beginning to shift back to the bond market going into Jackson Hole and the annual Fed get-together in Wyoming. Yields are higher at the long end, up by 2 to 467, up by 2 on 30s as well, at 518. Under surveillance this morning, setting the stage for Jackson Hole.
All eyes are going to be on Warsh on Friday.
Will Kevin Warsh say that we have a fiscal issue that's driving the inflation side?
Forward expectations around inflation is ultimately the self-fulfilling prophecy.
Broadening out the inflation view would be useful.
So here's the latest this morning. Global central bankers arriving at Jackson Hole, preparing for remarks from Fed Chair Kevin Warsh tomorrow. Sticky inflation, a rising US deficit, adding pressure to those comments. Torsten Slok of Apollo writing, the bottom line for investors is that interest rates are going to stay higher for longer. Torsten joins us now for more. Torsten, good morning. Good to see you, buddy. Good morning. What are you expecting tomorrow morning?
Well, I think that he will have to deliver something that is clearer than what he did at the July press conference. And the most likely outcome is that I think that he will deliver more clarity about his economic outlook. And I think that that will involve some framework guidance, not forward guidance, but some reaction function description that explains what do we think is going on with inflation, what do we think is going on with the labor market, and therefore a broad economic picture that the market then can begin to interpret as well. What does he put weight on when he thinks about where the economy is at the moment?
Is that going to have a hawkish flavour?
I do think that it will have a hawkish flavor because at the moment the risk is that if he does not give any framework guidance, the risk is that that will involve a much higher move in long rates because long rates need some more clarity around what are the reaction functions for the FOMC, what are the frameworks that they're using, are they going to tighten policy through rate hikes, through the balance sheet, through tighter financial conditions? Does he think the move higher in rates is enough to slow inflation down? Giving some guidance about what do they think at the moment is the outlook for the economy? Not in terms of forward guidance, but what do they think is where we are with inflation and unemployment? That must be the answer to what could at least solve this problem.
Is that enough, or does he need to go to a step further and say, if core PCE remains elevated, then we will be hiking? Does he need to be that explicit?
Well, I do not think it will come with numbers. The only number that he probably will say is 2% inflation, because that is ultimately the goal. But I think what the market is looking for, and what they will likely also deliver tomorrow, is that there is some need for a description of how do we get from 3.5% down to 2%. Do you expect that to happen in a few months? Do you expect that to happen over a few years? I mean, what is the path ahead of us, and what are the various forces in the economy that are arguing for why inflation is likely to come down?
Torsten, though, does that to some degree betray what Kevin Warsh has clearly communicated as his ethos? That is, that the market doesn't need hand-holding. If he comes out and acts in a way that is seen to hold the market's hand, doesn't it counteract this narrative that he's trying to portray, that is, I don't need to give explicit guidance. I don't need forward guidance. I don't need to hold your hand because there won't be issues with macroeconomic volatility. You can sort it out yourself, markets.
Well, and the problem with that is that rates are higher for longer for reasons that have nothing to do with the business cycle and nothing to do with what the Fed is doing. Number one, of course, the fiscal situation is not great. That's putting upward pressure on the term premium, on long-term interest rates. That means long rates are going to be higher for longer. In the front end, inflation is unfortunately not 2, it's 3.5. And given 3.5 is not 2, that means that he still needs to have a view on, well, what is the process of getting down from 3.5 to 2? And if we have inflation at this high level, we will also have rates higher for longer in the front end. And by the way, in the belly, because of hyperscaler issuance, we also have upward pressure on rates. So the whole yield curve is at risk of moving higher because we simply have some forces, in particular hyperscaler issuance and also the fiscal situation, that really is just not under the Fed's control.
This has been such an unforgiving month for the Fed chair, Kevin Warsh. The news conference was bad enough, but subsequent events have made it look even worse. So he's been reluctant to engage in communication about his reaction function and the like. And then the FT provides a view of how he thinks about the world that wasn't represented in the news conference. 1, 2, he wants to see an unfiltered message from markets. Then his Treasury Secretary steps in and provides a filter for financial markets. Can he take that approach anymore?
Well, the challenge, of course, is that there are other things than what the Fed is doing that are driving rates, in particular in the belly and further out the curve. And those are the things that he can't really do anything about. So a recognition of that there are other things could be one way to say, well, rates have gone up and there's not much we can do about that. But broadly speaking, what he can control is, of course, the front end. So a description of the economic outlook of what's going on with inflation, what's going on with the unemployment rate, all that would be very critical for what could be happening to the front end of the curve. The last thing on this is also, we might also hear something about AI, because this becomes really important for rates. If we take this conversation into 2027, think about it the following way. If AI fails, if this is a bubble and it bursts, we will absolutely have rates much, much lower. And then the discussion about the fiscal situation and inflation is probably going to be more in the background relative to the AI story. So if AI fails, let's agree, next year rates will probably be a lot lower. But if AI succeeds, and we also have massive disinflationary forces, because now the tech companies and everyone is making trillions of dollars, and that improves productivity and therefore lowers inflation, you could also have a scenario where AI, both if it fails and if it succeeds, that AI could result in rates being lower sometime next year. That's not where we are right now, but that might be helping him. So if he does talk about AI and saying what are the different consequences of different scenarios, that could be helping both in terms of rates in the front end and in the long end.
You gave us 2 scenarios there. Which way are you leaning?
So at the moment, I still think the market is trying to figure out, apropos the Nvidia earnings, what exactly is the scenario we're on. Are we on the scenario where things are about to turn south in terms of companies not seeing the payoff from AI? Or is there really a true scenario where we're going to see a dramatic increase in productivity? We've not seen that yet, or dramatic increase in particular in profit margins in the S&P 493, meaning outside of the tech sector, because we haven't seen that yet either. So the model through scenario, which is the one we're in at the moment, while we're trying to figure out, is AI widely successful or is AI a failure? That's the scenario where you still have weight put on the fiscal situation and the inflation situation.
He's given a hint of that, but let's say he leans really hard into the production boom scenario, the productivity boom scenario. this market's just going to think he's super dovish.
Yeah, because that's like going to the casino and putting everything on red.
Right.
And we do not know if it will be red. It could also be black. And that's, of course, why this risk is that if the Fed leans too heavily into one scenario and say, well, AI is going to raise productivity, that will solve all the inflation problems. By the way, that will also solve all fiscal problems. Well, if you do that, then if that does not happen, then we will, of course, have some serious problems, in particular in 2027.
Is there also a similar risk, not to the same magnitude, but a similar risk if he also leans on his committees, saying that we can't fully give his outlook because he's still waiting for results to see what they come back with?
Absolutely. The task forces, of course, that now will come later this year, of course, are very, very critical for the whole discussion of what is the Fed framework. So that's also why the tiptoeing from him tomorrow must also be taking into account that the task forces have not said anything yet. And now he needs to say something about framework guidance, and we will only get the task forces later this year. Surely he's already pointed to what actually most people agree. He's absolutely right that forward guidance is not a good idea. But what most people also agree is that framework guidance is a good idea. And now we need to get some framework guidance from him tomorrow, probably through the economic outlook. But we also will get much more framework guidance when the task forces come out later this year.
Does that mean any framework guidance he gives now we should be viewing as very short term and will change once we get the task force results later this year?
Well, this is why tomorrow may be more helicopter framework guidance rather than the details that we are probably going to get from the task forces.
Can I ask you a delicate question to wrap things up? Are you seeing signs that the committee's losing faith in their leader?
Well, at the last meeting, we had 3 dissents. But remember also under Powell in April, we also had 3 dissents. And in December, we also had 3 dissents. So it's actually not unusual, in particular more recently, to have 3 dissents. But it's, of course, very clear, and it's very important to remember that there are 12 voting members on the FOMC. The chair's most prominent and important role is to call the other members and try to figure out before the meeting, what are you going to do? What are you going to do? Yep. And what should we be saying? How do you think about this? And try to balance the consensus and figure out how do we come to some compromise. So he both has to clarify his own views, but the challenge is he also has to clarify the views of the others. And that's, of course, why this becomes very important from a committee perspective, namely what do they as a group think is the best response to where the economy is at the moment.
Do you think the others are becoming more powerful?
Well, if he decides to say very little tomorrow, and if he does not give any guidance on where he thinks inflation and unemployment is today, of course, the risk is that other FOMC members will get more, and meaning risk, meaning the consideration he must take into account is that others will begin to get some more attention. So the toothpaste will come out one way or the other, that people have views on all kinds of things, and suddenly the market will be paying a lot of attention also to what the Fed presidents are saying regionally, and of course the other FOMC members on the board.
I remember the conversation about a shadow Fed chair. We're just getting a very different shadow Fed chair if that's the direction of travel.
That is exactly what I was thinking. And remember how much hand-wringing there was over this, about how inappropriate it would be if there was a shadow Fed chair. We're back in that environment, or we actually are in that environment. You don't see the same kind of concern over it.
The old Fed chair is still on the board. It's gone nowhere. Torsten, thank you, buddy. Appreciate it. Torsten Slok of Apollo on a speech, an address from Kevin Warsh and Jackson Hole, potentially, according to Torsten, with a bit of a hawkish flavour, Danny, going into that one.
A little bit of a hawkish flavour and some sort of framework. Again, there are just so many things in tension with that very idea that he doesn't want to be giving any sort of forward guidance, but needs to give at least a framework in order to calm this market.
If he doesn't, the first thing everyone will do is just go to the speech schedule for September.
Yes.
Into the data, into the meeting.
And to your point, maybe all that does is make other FOMC members more powerful.
That's all we're seeing at the moment, at least. Up next on the programme, in the next hour, we'll catch up with Matt Miskin of John Hancock, Libby Cantrill of Pimco, the Kansas City Fed President, Jeff Schmid, and Francis Donald of RBC on this very odd US-Canada trade spat. All of that in the next hour. From New York City this morning, good morning. Equity futures higher on the S&P up by 0.4, on the Nasdaq up by 1%. In the bond market, yields up by 2 basis points. Your 10-year 4.67, your 30-year 5.18.
Environment where the data will look a little bit cooler in the next couple of prints, such that the Fed can avoid hiking and do it credibly.
What we need to learn from Warsh is how he parses The data.
It would be helpful if we understood his reaction function.
I think he's going to have to use this opportunity to talk more big picture.
If Warsh sends a signal to the market that he is focused on inflation, that really is going to also help flatten the yield curve.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. In your price action, the scores look like this. Equity futures up by 0.5 on the S&P, up by 1 percentage point on the Nasdaq. Thank you, Nvidia. Absolutely crushing it. In the pre-market, the stock is higher by close to 7% after delivering a major outlook. Revenue growth of 70%. The estimate was looking for 40. That's quite a guide from the biggest company on the planet. Elsewhere in the bond market, 2s, 10s and 30s. Bond yields look like this. Yields creeping higher at the long end by a couple of basis points of 467 on 10s, 518 on 30s. Heading into this, more data later. Jobless claims in 90 minutes time. Then the main event for the week, the anticipation builds. Kevin Warsh, Fed share in Jackson Hole, Wyoming.
So the risk event shifts from Nvidia. We get the all clear to Kevin Warsh in Jackson Hole, and it's a tall order for him to try to restore credibility at both this market and, as you've been speaking about, John, the rest of the board of this FOMC. How does he do that in a way that doesn't betray his ethos of not forward guiding this market, but still providing something that suggests that they are committed to combating inflation?
I mentioned it moments ago. For those of you just tuning in, I think that ended with the FT article. I really do. That news conference was messy. A week later, we get an FT article with sources close to the Fed chair suggesting this is what he believes, this is what he thinks. The balance sheet's not the primary tool, it's the interest rate. If you get a few more hot inflation prints, we'll be hiking interest rates. I think that just did away with that whole approach from Kevin Warsh a few weeks ago.
I can't imagine, though, someone so forcefully coming out and saying this is his whole shtick, all of a sudden abandoning that. I mean, you got to decide what's more important, I guess, your own ego and holding on to that, or credibility with the markets. It's a tough dilemma for just one human being to try to wrestle with. Maybe he tries to do an in-between thing, which I don't think the markets would appreciate either and would see through that.
The 30-year bond can crush one's ego.
Yes.
We've seen that in many ways in the last week. And now we have a situation where it looks like the Treasury Secretary is doing one thing and the Fed chair is doing another. Can we close that daylight tomorrow morning?
What does he say in terms of this market and what Treasury yields are doing? Because at his presser, he said it's doing the work for us. It's not a problem that rates are high because it's helping to constrain financial conditions. What happens when it's no longer something that's giving you a clear read on this economy, and if anything, perhaps is trending lower because of forces outside of this economy?
That was the protest vote following that news conference with Kevin Warsh. You sold the 30-year. Yields started to creep higher. The Treasury Secretary stepped back in with some verbal intervention to keep yields lower. And as Torsten Slok indicated on this program 10 minutes ago, if you don't get that hawkish flavour, you'll start to see that leakage at the long end all over again.
One of the important things also, if he does give that hawkish flavor, is it helps squash any concerns of fiscal dominance. Not only is he trying to show that they're credible to fight inflation, he needs to show that they're not keeping rates low because of how large the debt is and doing the favor of this White House. Fiscal dominance is a concern across the globe right now, considering the situation that many countries find themselves in. And central banks need to show that that's not what they're about, that they are moving based on what inflation is showing.
Yields up this morning by a few basis points, 518 on 30s. Equities doing okay, up by 0.4. Coming up this hour, we'll catch up with Matt Miskin of John Hancock as Nvidia's blockbuster earnings spark a tech rally. Libby Cantrill of Pimco blaming both sides of the aisle for the bloated US deficit, and Francis Donald of RBC as the top US trade official floats a ban on Canadian goods. We begin this out with stocks rising as Nvidia's bullish outlook leads tech higher. Matt Miskin of John Hancock writing, earnings season has been heavily influenced by equity gains. Anything other than full risk on positioning has been left in the dust. Matt joins us now for more. Matt, welcome to the program. Let's just pick up on one single name, Nvidia. If that stock doesn't rally into the close today, if that stock doesn't finish today higher off a revenue guide that big, Matt, what would your takeaway be?
Yeah, it's a bit of a selling of the news if that did happen, John. But look, we've been coming into this with a sell America type mentality for markets. And in America right now, you've got the best earnings growth in the world of 52% outside of 3 companies in emerging markets that are selling to US hyperscalers. You've got a PMI. The August PMI was 56, John. That is a blowout number, highest in the world. And yet the US can't outperform any market in the world. Right now, stock market-wise, we've been giving out participation prizes. Basically, it's like, if you're a stock, any stock on the planet, we love you. any bond on the planet is hated. And so right now you're looking at these kind of numbers. Nvidia and the tech sector, AI has been an earnings momentum freight train that just has not stopped. We've been overweight tech or calling for an overweight for tech for 10 years. We've held it. It's high quality companies, good earnings growth, high return on equity, amazing margins. Yes, the valuations are a little rich, but when the earnings are growing this fast, they deserve it.
Nvidia in the pre-market higher by 6.7%. We'll see if we hold those gains, Matt. I think most people hope we do. You mentioned the bond market. Are we close to that flipping point, that tipping point where I start to tip into bonds, tilt into bonds and tilt away from equities?
We are looking at the backup in bond yields opportunistically here. And, look, if we can do 5 to 6% in high quality bonds, even just a little bit of a corporate credit bias and single A kind of corporates, we're pretty happy. Investors over time have had to go to the bond market in much lower yield worlds. Negative yield worlds of the old days, John. God, way back time machine. But now we're sitting here at 5 to 6 and no one wants a bond anywhere on the planet. And we're sitting here saying, look, investors in retirement mode. And even, look, even my mom right now, I'm like, hey, take a look at the 2-year, take a look at a CD that's a couple of years out, try to refinance some of this stuff, try to get, a little bit more incremental yield right now. But the sentiment is so negative. The stock market is just taking in so much capital. We've seen about $12 trillion of market cap gains year to date. But in our view, it's not like I'm saying out of stocks, but I'm saying incremental dollar. Some of these bonds look pretty attractive.
Matt, does this speak to a wider problem? So on one hand, you have a very unloved bond market. On the other hand, you have an equity market, as you were outlining, that's no longer outperforming its international peers. Part of the economics of this United States is the fact that it is the hub for investment. This isn't full scale. We don't believe in the U.S. full scale debasement. But at the margins, just given those things, is something creeping in that's problematic?
Yeah, Danny, and it comes back to the dollar. Like you said, debasement, and it made me think of the dollar debasement trade. And right now, there is a confidence issue. When the Treasury Secretary has to step up. Now, look, drawing lines in the sand can get overwhelmed by the ocean. And this is deep thoughts by a market strategist at 7 a.m. And I know that's a lot, but what I'm saying right now is that if you can try, the Treasury Secretary is saying, look, at 5% or just over 5% of 30, we're going to do $4 billion extra. It's a $40 trillion market. That is a drop in the bucket. But when the Treasury Secretary has to come in and do something like that, the dollar weakened, the Treasury yields didn't even fall that much. So the actual impact of this was a weakening dollar. A weakening dollar just ignites non-U.S. equities. It lifts gold. Bitcoin even has gotten a rally on it. It's another risk-on lever, but it's hard to see the U.S. momentum with a weaker dollar. You're going to see better spots. I don't know if you're going to continue to see that. Lines in the sand, like I said, can get overwhelmed by the ocean coming in, and we're going to have to see how the market digests all this.
So, Matt, as that ocean comes and wipes away some of those lines in the sand, do you want to be stood there with a gold bar in your hand?
Yeah. So, I think right now you got to disseminate between, policymakers trying to draw lines and then the fundamentals and where we're at. And, you come on the show and I listen to the show in the morning and a lot of it is higher for longer. And, rates are just going to keep going up. And I don't know, last jobs report last month was negative. We had mortgage data just Wednesday and mortgage refi apps are coming down, higher mortgage rates. Housing data continues to come in really weak. And so I'm sitting here saying, higher for longer. I don't know. The jobs market's not that strong. The housing market's not that strong. Wage growth isn't that strong. I get it, the stock market. If you took out the stock market right now, I don't think we'd be seeing nearly this kind of economic growth that we are seeing. The wealth effect, actually, Danny, you were talking about this earlier. The wealth effect is massive. And so, I don't prescribe to all that as much. I think this backup in bond yields is one of more of sentiment and just kind of confusion around the Fed chair baton passing. But I would look at that opportunistically and nibble at some of these bonds.
Risk appetite is buoyant. Nominal GDP is close to 6%. There are a lot of reasons why yields should be higher. Matt, I got this note from a Bloomberg subscriber just moments ago. I'll share it with you and our audience. He says Warsh is credible. In fact, he's been right about a lot so far. Inflation has surprised consistently in one direction. Yields have moved higher globally. Do we really think a rate hike or a series of hikes would have done anything because yields are not being driven by inflation? And it's comical to suggest they're being driven by deficits. He goes on to say, which are not new, and because of the expanded Fed balance sheet, only leave debt of GDP to GDP closer to 80%. Matt, do you think the Fed share is getting an unfair rap into Jackson Hole?
Well, so let's start with the inflation part of that. And you got to go inside baseball with this, John. It's complicated. But look, core PCE that came in yesterday, half of the gains were portfolio management fees. And look, I'm in the financial services industry. You know how many companies right now are raising their fees? Basically none that I know of. What that calculation is, it takes the stock market gain and then takes whatever the fee is and multiplies it by that. So it makes it look like it's higher, but it's not really higher. You know, you're not seeing a price, you know, higher prices in the portfolio management world. The housing side, you know, Zillow says national home prices are up 1% year over year. The Bureau of Labor Statistics says it's more like 3%. That just seems really overstating the housing side. So, you know, if you strip it all out, all right, look, if I said core CPI is 2.5% and job growth was negative in the last month, are you telling me that the Fed should be hiking on that? I disagree. So, and I think it's more about nuance. Like if Warsh is letting yields do the work for them, this is trial and error. And I know it sounds crazy because it's like, look, Fed policy should not be trial and error, but
I think we've lost that connection. Are you back, Matt? I think we lost you for a while. Complete your thought if you can.
If the bond market loses the economic data and that breaks, it's going to lead to tightening that's unwarranted. You got to be really careful coming into Jackson Hole.
Matt, does that mean then that this is a chair who should not come out at Jackson Hole with a hawkish speech?
I think he's got to be really careful because if the long end blows out, Danny, he's going to have a litany of problems going into the end of the year. And if he has to keep on relying on the Treasury Secretary to do the job for him, I think that's going to lead to problems. And so I think it's got to be more measured tone. And again, like other guests have said, which I totally agree with, show me what you care about. What are we watching? And if you lay that out and you make it clear in what's going on, what we're watching, I think that would gain a lot of confidence and help Treasury yields calm down.
And Matt, do you think he has that much influence right now over the long end?
Well, when you let it go and you don't do anything, then it shows that, yeah, I mean, he almost didn't want influence to start. And I think that was a misguided. I think he should have had a task force, ask a task force about, should I just let Treasury yields do the work for me? And I think the task force would say, no, you've got to instill confidence in the Treasury market. We want to have more precise policy. Danny, you mentioned it earlier. It's a blunt tool, monetary policy is. But if you let the tool just kind of do its own thing, that blunt tool is going to have side effects. It's going to knock on things that it shouldn't. So I think you got to bring policy under control. I think you need a steady hand and you need to show control or a bit more control. I'm not saying it has to be 100% control of Treasury yields and what the short end is doing.
Matt, it's good to see you. As always, apologies for the technical problems there. Matt Miskin there of John Hancock weighing in on the Fed situation. I got this from a Bloomberg subscriber as well in the middle of this conversation. Complete opposite view of the one I read, which is if the Fed does nothing, we approach month 70 of missing inflation targets. Wild to think we keep advocating the Fed to do nothing and miss half their mandate.
Well, one of the things I was thinking about is, as Matt was also speaking, is one of the things we got clear from Chair Warsh when he came to the helm at the Fed is his concern over this housing market. And how do you fix the housing market? You have to bring the long end in. And how do you bring the long end in without committing to something that looks like a rate hike? How do you do that? Does he have other tools in his toolbox? It just shows the complexity of the task at hand. And he's new at this. I guess he's going by trial and error, as Matt says. So can he confidently do it?
I don't think he wants to use the balance sheet, that's for sure. Yields higher at the long end this morning by 2 basis points. 518 on 30s with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Nvidia shares higher by 7% plus now in the pre-market. The AI giant topping earnings expectations and delivering a bullish sales outlook. Nvidia projecting to grow revenue by approximately 70% in fiscal 2028. That's nearly double what the street was expecting. Central bankers gathering today in Jackson Hole, Wyoming, and they'll be focused on inflation and the prospect of higher borrowing costs. Upward price pressures from the Iran war and the AI boom pushing some central banks to raise rates already, with more expected to follow. President Donald Trump signing an order aimed at easing tariffs of select ground beef imports to lower costs for consumers. Lean trimmings will be exempt from the higher duty for 90 days if they exceed a preset quota. Move angering some ranchers and Republicans ahead of midterm elections. And that is your Bloomberg Brief. John.
Bonnie, thank you. It's a strange approach, isn't it? Tariffs don't hurt consumers, but we remove tariffs to help consumers.
Right.
Can you make sense of that for me?
And also anger this base of ranchers. I can go on a whole rant about beef. It's been a problem in the U.S. for some while.
Yeah.
We've removed a lot of things that say you need to know where the origin is, and now we're getting like weird pink slop in different hamburgers.
We'll spend some time on tariffs and not the weird pink slop a little bit later this hour. Up next on the programme, drawing a line in the sand.
It's not 100% clear to me why they would be doing this now or what the definition of success is, other than there may be an idea of, drawing a line in the sand.
Up next, we'll catch up with Libby Cantrill of Pimco, live from New York City this morning. Good morning. Nvidia this morning higher by more than 6%, up at the moment in the pre-market, in early trading, up by 6.5%. You'll hear this stat a lot this morning, that Nvidia, the stock has fallen the day after 5 of the 6 last earnings reports. If this stock doesn't finish positive today, that would be an absolute shocker, given the revenue guide they put up yesterday afternoon.
Oh, it would be hugely troubling. But in the meantime, as it climbs higher, one viewer wrote in to note that for every percentage point it moves higher, it adds $25 billion in market cap. With every single percentage point, we're up more than 6%
crazy?
now.
That's like your average European company, like each tick.
Yep.
That's
Nvidia
nuts.
slowly becoming larger than the entirety of Europe. Yeah, makes sense.
The stock in the pre-market up by more than 6%. Under surveillance this morning, we need to talk about this bond market, drawing a line in the sand.
It's not 100% clear to me why they would be doing this now or what the definition of success is, other than there may be an idea of, drawing a line in the sand, not wanting to see an ongoing rise in terms of 30-year yields. The big thing is fiscal. We get compensated for the risk.
So here's the latest this morning. Investors remaining sceptical of Treasury Secretary Scott Bessent's bond buyback plan as the US deficit balloons to more than $40 trillion. Libby Cantrill of Pimco writing, both Republicans and Democrats have a spending and tax problem and are both responsible for the run-up in debt. Libby joins us now for more. Libby, good morning.
Good morning.
Any sign they want to do anything about it?
There is literally zero political appetite.
It's not even part of the conversation, is it?
No, and this is where I think the irony, I think that the market sort of faded it. But when Secretary Bessent came on last week and said that he has a sort of fiscal consolidation plan and it's going to be announced, anything that is not announced with Congress, everyone should just sort of fade, to use a trader's term. And it is just not a serious proposal. Of course, 75% of government spending is on autopilot. It is mandatory spending, Medicare, Social Security, Medicaid, as you all know, and then interest expense. And so Congress does, they control annually sort of 25%. And within that 25%, it's only growing, right? There's a request for more Pentagon spending, for more non-defense discretionary spending. So I think the bottom line here is that everyone should discount any discussion about deficit reduction until Congress is involved. And as of now, they're very much on the sidelines.
What was strange about the intervention for me is it's difficult to say we've actually seen a fiscal scare. I don't think we've seen one yet. I listened to Andrew Balls, you and the guys over at Pimco. Have we seen a fiscal scare?
No, and this is what I think is a little bit curious, is that the intervention, the bond market is actually behaving exactly how you would expect it to behave. It's pricing in, by the way, higher growth, a little bit, concerns of inflation, higher CapEx spending, and then higher deficits. But none of this is new. This was not like except for that $40 trillion headline. None of this is sort of new news. So, we would say, steeper yield curve, good for investors, good roll down opportunity. And exactly, and to Andrew's point yesterday, this is a bond market that's quite healthy. So the intervention was curious. I do think there are lots of open questions, as you guys have have sort of litigated on the program. Lots of open questions about this buyback program. Of course, it only extends through November 4th. Will he extend it again, right? I mean, there's I think, an open question. And then really, kind of theoretically, this is a $14 billion program. I mean, that's, maybe that's the floor, not the ceiling, but that's not a huge program when we're talking about trillions of dollars of debt in terms of issuance.
So, Libby, when we read the White House policymakers, Congress's approach to the deficit, should we be viewing it on the lens of the actions that they're taking are trying to run this economy hot, are trying to grow our way out of the deficit, or is the deficit just a non-issue?
Well, I just don't think that policymakers on Capitol Hill are really necessarily connecting the dots. And these are smart people, but they're not markets people necessarily. I think there are a handful of folks on the Hill that are concerned about the deficit, that are concerned about interest expense. But I'm not sure there's a real directional view of trying to stimulate the economy or pulling back on the economy. Again, a lot of the spending, the majority of it, is on autopilot. And then the stuff that Congress controls is really pretty parochial, right? It really matters to their constituents, to their districts. And so they're taking much more of a micro view than a macro view. To be clear, though, we do think there will be a reckoning here and that Congress will have to act. I just don't think it's imminent. Unless this becomes a real political issue and voters are demanding that Congress acts, I just think, as long as the music is playing, they'll kind of keep dancing.
Is there really a future in which voters force Congress to act, that voters start caring about the deficit?
If Lisa were here, she would know. We talk about the Social Security Trust Fund, walking out. Again, that's sort of 2031, 2032. That does feel like far in the future. But that is, if Congress does nothing, there will be a 20% benefit cut for Social Security in 2032, according to the Social Security Trust Fund. That is not tenable politically. That could force Congress's hand. And you'd have to do it way before that. And so this, if you remember Simpson Bowles, the grand bargain, you guys are too young to remember this, but you remember President Obama's kind of grand bargain never really got traction, but I do think that we'll see a revisiting of that, where you have to, yes, reform spending, but you're going to have to increase taxes. Sorry, it's just the math just does not math, to use my 11-year-old's term. It just will not work sort of otherwise. So this has to be balanced, and it has to be bipartisan.
Danny mentioned housing. How do you assist what's happening in housing right now?
Yeah, so the housing market, obviously, this sort of lock-in effect has been just incredibly pernicious for the housing market. Housing starts, all of the data obviously just shows a pretty stagnant housing market. This is an area that voters do vote on, right? Gas and groceries, healthcare, and also housing. And so if you think about what are the tools in the White House's toolkit to actually use to stimulate housing, there's one big bazooka that they really have not used to the extent that they could. And that is going into the market and buying more Fannie and Freddie agency MBS. That's sort of a technical demand that will theoretically suppress yields. I do think that as we get closer to the election, we may see Director Pulte at FHFA revisit that. He's tweeted about this. I would not be surprised if this does not become more of an issue as we get closer to the midterms.
Libby, it's good to see you.
Good to see you.
Always is. Thank you. Libby Cantrill there of Pimco. Libby, thank you. The housing market's a massive issue. The lock-in effect that Libby's talking about, it's such a pain because if yields go up and people can't afford to borrow, you'd expect a correction in price, but you don't get one because the people that are locked in just stay locked in even more. They refuse to move. The supply doesn't come online. This is a major issue in this economy right now.
It is a major issue, and there are various things that might help them, to the point of Libby, Fannie and Freddie, maybe giving people locked-in mortgage rates that are transferable, that you can bring out from where you elsewhere, and things like localities reducing red tape. You're not seeing that, though. Instead, you're starting to see this morph into just things like data center backlash, and that seems to be what politicians are grabbing onto.
Yields this morning up by 2 basis points, 466 on 10s. Up next, the Kansas City Fed President Jeff Schmid on the growing pressure to hike rates. Equity futures pushing higher this morning, up by 0.4 on the S&P. On the Nasdaq, higher by 1 percentage point, supported by a 6 to 7% move on shares of Nvidia in the pre-market. In the bond market, 2s, 10s and 30s. Yields shaping up as follows. Yields this morning up by a few basis points, 422 on 2s. On 10s this morning, up by 2 at 466. On 30s, up by a similar amount, 518. The Fed's Jackson Hole Economic Symposium kicking off today in Wyoming. The Kansas City Fed President Jeffrey Schmid saying demand pressures could justify a rate hike as soon as September.
Inflation is basically back to where it was when the Iran war started. You didn't like it at that level then.
Yep.
So I assume at this point, even the slight decline that we have seen in recent weeks is not good enough.
Yeah. So first of all, welcome to Jackson Hole, Mike. I mean,
it's always great to be back.
Yeah, it never gets old, does it? Yeah, yeah. Well, it's great to have you. Thank you. Yeah. So if I'm going to be consistent, and I was a voting member last year and dissented a couple times. At the time, even the last Q3, Q4 data for me last year was. I thought we certainly weren't restrictive and maybe even a little accommodative. So we've got work to do. There's a demand element underneath all of the supply conversation that gets talked about that I just need to try to figure out, because for me, we do a lot of informal surveying around the district, and I would say it's kind of a little bit like the FOMC meetings. You've got a half of the people that say, well, it's certainly not restrictive. It seems like it might be close to about right, but for me, I think it may be accommodative on the short end.
How do you measure that?
So it's a really good question. And look, the data sets are massive, right? I mean, what you've got to do, I think, and I even have a tendency to do this, is you got to be careful about looking at, one or two prints. You really have to be thinking about the macro over the micro, because even in the district, I can get around to places, and some communities are booming, some are just doing okay. I mean, I think even about industries, the cattle industry is booming, but the poultry industry is soft. And so you really do have to be thoughtful about that, because what happens to me, and this has been my personal experience over the last 3 years, is we got it to 3, sub 3, and then it even gets harder because you don't want to overshoot with the policy rate decision. So you want some deflation down to 2, but you don't want you want deflation but not disinflation. And so that it gets harder. The decisioning gets harder. But for me, I think there's a lot of demand elements underneath this economy that I think a bit higher rate might make sense.
As soon as September 16th?
So I think for me, giving the chairman some room is important. I think these task forces are going to be instructive. I think the FOMC is looking forward, in my opinion, to those. I think there were some of my colleagues dissented at the last meeting. So I would probably put myself in that camp. But here again, there's really good arguments on both ends of this policy decision. So let's get a little bit more data. Let's see what the task forces are going to say over the next successive meetings. Maybe there's a bit of a reset that we have to make. But for me, I think we're a little on the accommodative side.
Well, if you probably can't make this official pronouncement, but would you assume, as most people do, that October 28th is off the table because it's too close to the election?
I don't think so, Mike. I think we had this discussion about independence. We get in that room. We are able to speak our truth about what we think the economy is doing. I just don't think it enters into the equation. It certainly doesn't enter into my equation. We have a mandate. It's keep prices at 2% inflation and keep employment and labor full. That's a pretty simple mandate. So I can make decisions. I can at least offer my opinion around that and be hopeful that maybe other folks on the FOMC think the same.
If you're saying you don't need to raise rates necessarily immediately and you want to give the chairman some room, what's the balance of risks to the economy given that policy works, as we all know, with a lag?
It does, yeah. So that is the classic decisioning and debate, right? So here again, not to overshoot, and I think that, but here again, we're in the 3s. I think that argument's better when we were in the mid twos and we were trending nicely. Well, then we had a couple shocks, and now we're trying to work through those shocks. But now you've got this really interesting dynamic of technology demand that's creating really issues with a lot of commodities, be it steel or copper. You've got this kind of flywheel of development around data centers and AI. That's creating some demand, certainly creating some inflation underneath the energy shock side of things. So we've got to really make some hard decisions about, can the policy rate affect those demand elements without pushing your economy into a slow growth or no growth area.
Well, two questions here. And the first one is, does the Fed have a credibility issue? There's a lot of talk about on Wall Street that it might.
Well, for me, I just don't see it. I mean, I think if you look at the two great cycles that challenged the Fed, be it the post-08 and the post-COVID cycle, we might have missed a few things early in the 21-22 cycle, but we used policy rates to try to push inflation down. We were trending pretty well. I think we were doing our job. I think we were thoughtful in some of those moments where the labor force was structurally changing, which it still is. And so for me, I think we're doing our job. We just haven't gotten to the point where we can say, hey, we're at a good place. Maybe reminiscent of kind of the cycle of the 90s, where you get inflation down to 2%, you have full employment, and then you start to use your policy rate in kind of a cycle and wave to just keep the economy moving along well.
Well, the second part of that question then is, does Kevin Warsh need to do something to satisfy the bond vigilantes?
Well, look, I've really appreciated getting to know Chairman Warsh since he came around. I think he has a large imprint in his career about what he believes and what's important, how he views the Fed's mission, so I think every time that he has an opportunity to speak, I think he's going to add to the discussion about how do we fulfill our mandate, because he believes strongly in it. So I'm like everybody, I'm looking forward to it, and I think he'll impress. He always does.
I'm sure you read the commentary from the Wall Street analysts who say that Warsh needs to tell us his reaction function. So to be fair, what's your reaction function?
So I think that probably is the focus that we're going to talk a lot about that comes out of these task forces. I mean, I think things like data and communications are going to be really key of the 5 task forces to say, okay, is there a way to reset this kind of post-pandemic relative to what we did before and what we need to do going forward? And so I think we've got big issues, and this economic symposium here in Jackson Hole is going to talk about financial innovation. It's going to be talking about things like that are important to me, things like instant payments and how the market supplies that instant payment pipe with liquidity. And so there's going to be a lot of things that come out of this in the next 2 or 3 days, including his speech, that I think are going to be very additive to how we fulfill our mandate.
A couple of things on communication. Do you think that the chair should continue to do news conferences after every meeting?
So for me, I think about that as from what I do as a Fed president, and I'm a transmitter of information. So I go around the district all the time. I have roundtables. For me, the Kansas City Fed's kind of a power utility center. I'm the conduit of information. So it really is kind of a personal, how do we want to fulfill our duties and our mission? I bring information from the FOMC table to my constituents here. I take what they say and I listen to them and take it back to the FOMC table. I think he has a much more macro role in that, and I think he'll decide how he wants to do it.
What about the idea of moving back to 6 meetings a year that was discussed at the last meeting?
So here again, I think there's around data and communication, I'm going to be really fascinated at what things we can do relative to giving us more time between meetings and bringing that data more real time. I hope we can get there. I hope we can use some of the technologies that are out there today, be it AI and other technologies, to really pull information forward. And I think fewer meetings might make us more effective if we have more information, but that information is going to have to be more real time than it is today.
Yeah, but everybody who works in the research departments at the regional banks and the folks at the Fed in Washington and the folks at the statistical agencies say we are using real-time information. We have contracts with a lot of companies that are giving us data in real time. What are you missing?
So there, I think there's, I would disagree with that. I think there's too much lag in the information that we get. I think that there's ways that we can connect. I'll give you an example. I'm a former banker. We would submit call reports every quarter. By the time the examiners would look and analyze that information, it's probably 6 weeks after the quarter end. If we could connect closer with the banking industry to actually maybe electronically be connected, maybe we can get more real-time data from the banking industry specifically that would really bring that. It would today a call report looks like a slow-moving vehicle to what AI can do today. So the connectivity side of it, we can do better.
One thing, as the last question I want to ask you, is that you look around and you see all of the television set up here and all of the people who come to this event. What do you think of the symposium and the way it's evolved over the years? Is it still true to what the original founders wanted?
So there's a special sauce to this symposium, no doubt about it. It's our 50th year next year. I mean, so something's working. But I tell people that ask, there are really three elements to this symposium that make this effective. One is, I mean, obviously it's a great place to be, right? So we give the participants an opportunity to explore Jackson Hole and the region. Two, Joe Gruber, our chief economist, has one of the hardest jobs because he and his team have to decide what subject matter is going to be relevant in August, and you have to make that decision in the November prior. And so you hope that subject matter is relevant. He's knocked it out of the park this year with this whole financial innovation and payments business that's really going to be disruptive over the future. And then the participants and the way we're able to get in a room and debate some of these things that are happening. Chairman Warsh's speech on Friday is going to add to the conversation on Friday and Saturday, and we're going to wake up on Monday morning and have new thoughts about what's happening in this economy and what the Fed should do. And so it seems well timed, but the sauce is really about the people involved in it.
Do you have any idea what he's going to say?
I wish. I don't. I'm a warm-up act here, Mike. So
it is the most beautiful shot in financial TV. Mike McKee, fantastic job with the Kansas City Fed President Jeffrey Schmid. And Mike, welcome to the program, buddy. It's underway. Walk us through what we can expect in the next 24 hours.
Well, I have to tell you that we are indoors because it's completely dark outside. But in a few minutes, you'll be hearing from Lisa Abramowicz and me outside when the sun comes up. Today is kind of arrival day for members of the Open Market Committee and the others who are attending the meeting. It begins with a dinner this evening, but there's certainly going to be a lot of talk in the halls about what is going on with Kevin Warsh, what is going on with the bond market, and whether he's going to be able to de-stress the bond market while not giving too much away, since he doesn't really want to talk about it. And then, of course, the overhang is Lisa Cook. What's going to happen with that? She filed her response to the president last night. What's the president's response going to be? Is he going to try to fire her again? And that would certainly be a topic of conversation in the hallways, if not in the official program.
Mike, can we talk about the official program? This year's theme will explore financial innovation, implications for payments and policy. How far and how broad can the Fed chairman take it if he wants to tomorrow morning?
Well, he could certainly take it a long way in terms of describing the issues, because the payment systems, the payment rails are changing. We're seeing instantaneous settlement. Is that always a good idea? The idea of using stable coins, the banks were all against it, but now they're issuing their own stable coins. So who's actually going to be in charge of that? Those are all issues in Fed plumbing and central banking plumbing that are going to really matter to financial institutions and to central banks. And that's kind of what I was getting at with Jeff Schmid. That's what this conference was founded to do, is look at issues that are going to be coming up in the future and try to figure out the best policies to deal with them. This year, it's maybe a little less exciting for the average person, but I know a lot of the Fed people are very interested in what we're going to hear here.
Right, looking forward to catching up again in about 45 minutes. We'll have some fresh data. Jobless claims about 46 minutes away, to be precise, at 8:30 Eastern Time. Can you imagine if we get a speech tomorrow on Federal Reserve plumbing and payments?
Right, Chair Warsh just gets up there and talks about stablecoin.
Just imagine
and
the
that's
reaction.
It. Oh yeah, it wouldn't be good.
Shocker.
It could happen though. I think we need to brace ourselves for the possibility that he uses this as an excuse to talk about those long-term issues and not about policy for the rest of the year.
It's a low probability event. It would be shocking if it happened. Yields this morning higher by a couple of basis points, 10 to around 4.66. Let's get you an update on news elsewhere with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Dollar General shares rising in the pre-market after beating second quarter earnings estimates. The company raising its comp sales forecast for the full year. The CEO adding the company has seen 5 straight quarters now of customer traffic growth. CrowdStrike's projected full-year revenue exceeding analyst estimates. The security software firm reporting Q3 sales reaching up to $1.53 billion, above the average analyst estimate. The report indicating that the AI fuel-led demand continues to benefit the cybersecurity industry. Shein is said to have raised $1.7 billion after pricing its Hong Kong IPO. Sources telling us here at Bloomberg shares are likely to price just above the midpoint of the marketed range, valuing Shein at more than $26 billion. Trading is expected to start September 1st. And that is your Bloomberg brief. John.
Vonnie, thank you. IPOs, equity supply, debt supply, the competition for capital everywhere you look right now. Up next on the programme, we'll talk about trade escalating, US-Canada trade tensions.
We offered them an even better deal. They decided to reject this and go in favor of some of the rhetoric you're seeing now. This is just not going to lead to any economic Armageddon for us.
We'll talk about the economic consequences with Francis Donald of RBC. Still positive somewhat. Gains are fading just a little bit as we get closer to the opening bell. Equity futures positive by a third on the S&P. On the Nasdaq, up by 0.8. Out of surveillance this morning, let's talk about trade. Escalating US-Canada trade tensions.
We offered them an even better deal to reduce their tariffs on steel, aluminum, autos, and lumber to the best in the world. And we believed we had a deal. They took issue with how some of it might be implemented. But ultimately, when what seemed like a political decision, they decided to reject this and go in favor of some of the rhetoric you're seeing now. This is just not going to lead to any economic Armageddon for us.
So here's the latest this morning. The US Trade Representative Jamieson Greer suggesting Washington should consider a ban on some Canadian goods as the trade war between the two nations intensifies. Francis Donald of RBC writing, the path to end the current additional tariffs are highly uncertain. Trade across the Canada and US border is mutually beneficial, and we argue for the bulk of trade to remain tariff-free. Francis joins us now for more. Francis, welcome. Let's just set the stage. How much of trade is duty-free under USMCA right now, and what are we fighting over over the moment between the US and Canada?
There are a lot of fights between US and Canada on trade, but currently 80% approximately of trade is tariff-free. And that's because even though USMCA, or CUSMA as they call it in Canada, is still in place, that doesn't cover everything. So there's a long list of Section 232s, 301s, and now this new tranche of tariffs, Section 338, that is impacting a meaningful amount of trade between the two countries and having an impact on both economies. Now, right now, it's minimal and marginal, but there are certain sectors in both economies that are coming under stress. And there are certain states, particularly now some swing states in the United States, that are going to feel some pressure from these Canadian counter tariffs. But all in all, John, the issue is that these are two countries that are each other's largest trading partner. Canada is America's largest trading partner. It's the #1 destination of exports for 34 states and is first or second export for 45 states. The United States is hugely dependent on Canadian crude oil, electricity, potash. The list goes on and on. Free trade between these two countries leads to both countries' prosperity. So while we're focused on Jackson Hole and the long end of the curve, we also need to be paying attention to what is this incremental additional exacerbator of higher inflation and slow growth.
Many, Francis, of course, desensitized by the experience of last year, might consider this noise and not news. Ambassador Greer said this is not going to lead to any economic Armageddon for us. You alluded to maybe some economic tensions in swing states and elsewhere in the specific sectors. Where are you seeing it right now, and where could it go in the next year?
Well, I think one of the challenges is that initially following Liberation Day, we all did our analysis and said, here's exactly what will happen based on growth and inflation and jobs. But there have been more than 50 changes to tariff policy per the Tax Foundation's calculations over the past year. Remember, we had IEEPA tariffs put on and then removed and then replaced with a different one. And now there's questions around refunds. So the American economy is still absorbing the tariff shock. And one of my concerns is that because it's been more of a slow bleed than it has been a very sharp impact, it's become a secondary part of the American economic story when really it should be one of the central ones. Here's another example of that slow bleeds currently in play. Americans front-loaded an enormous amount of tariff-free inventory before tariffs hit. We're in the middle of the 5th consecutive quarter of inventory drawdowns in the U.S. We've never seen this outside of large recessions. And that means Americans are still absorbing inventory that was tariff-free and purchased before. So we need to keep our eye on things like goods inflation. Remember, goods inflation was running around 0% and has climbed up to 1%. When IEEPA was removed by the Supreme Court, we saw some reprieve. But if trade tensions reaccelerate, you should expect goods inflation to rise. We've seen trade job losses. Last year, America lost over 150,000 trade-related jobs. That's tariff impact in play. Again, started to do a little better when we saw some reprieves, but a re-escalation of trade tensions, that's problematic for the economy right now. But big picture, John, we talked about Canada, US specifically. This is a lot of the statistics around U.S. dependence on Canada is based on the old economy. But if you think about where the economy wants to go in the United States, where the Trump administration hopes they can take America, supply side, agriculture, energy, AI, they're going to need oil imports, electricity imports, potash, uranium that comes from Canada. So America's success is going to depend on a de-escalation with Canada right now, or at least it will be able to move more quickly and secure more prosperity if we can see some de-escalation on both sides.
Francis, I know this is super important, and I don't mean to reduce the importance of it, but it feels so strange talking to you without talking about Warsh tomorrow. Can I squeeze it in? We've got like 45 seconds left. What are you expecting to hear?
Payments and process. Maybe I'm just a little too animated about trade discussions, but again, it's hard to go into listening to Warsh without realizing this is a Fed that is facing a growing list of stagflationary type of shocks, from higher inflation to slower growth, and yet conversely a labor market that is very structurally tight. I just want to know, how is he balancing all these things? I'm just not sure I'm going to get any of that information in the next 48 hours.
I just hope we don't get a speech on payments, that's for sure. Francis, thank you. Francis Donald there of RBC on the tension between the US and Canada, and a little bit of Warsh at the very end.
You don't want to hear him talk about stablecoin, John?
No, I've got no interest in that right now.
I would love to know what his viewpoints are.
I'd like to know what the 30-year does if we get that speech.
I don't think it would look pretty. I think that's fair to say.
It would not be good. Up next on the programme, Savita Subramanian of Bank of America, Gil Luria of D.A. Davidson, Nela Richardson of ADP, Michelle Weaver of Morgan Stanley. Your equity market doing OK. Equity futures up 0.4% on the S&P. Nvidia absolutely crushing it. The Nasdaq higher by 0.9.
AI remains the main story for good reason.
The CapEx continues unabated.
The broader tech ecosystem, that resilience, I think, is fragile.
It's sort of a tug of war that goes on.
But from a demand perspective, it's accelerating, not decelerating.
What's becoming more and more important is that diversification away from AI risk.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures doing okay, up by 0.4% on the S&P. On the Nasdaq, up by 0.98% of the Nasdaq 100 comes from this one name, Nvidia in the pre-market. Nvidia in the pre-market up nicely, up by more than 6%. About 90 minutes out from the opening bell. In the bond market, 2s, 10s and 30s, yields creeping a little bit higher throughout the session so far, up by a single basis point in 29 minutes time. More data for you, jobless claims. Then it's on to tomorrow morning. It's the headline event, the headline act of the week so far is Kevin Warsh speaking to Jackson Hole, Wyoming, heading into the weekend. We hope he talks about the economy, about interest rates. We fear on the margin maybe there is a low probability likelihood that he talks about financial payments and Fed plumbing.
Really hope that doesn't happen, and I fear for what this bond market does if that is the case. But if we do get any sort of financial policy speech from him, John, the range of views that people have right now is quite staggering. To hear from Torsten Slok saying that he needs to come out, he needs to be hawkish in order to give some sort of framework for this market. And then hear from Matt Miskin saying that would be a mistake to be hawkish right now. That is not what this economy needs. In fact, it is an economy that is showing pockets of cooling. You can get those different views. And then we have a Fed chair who himself in the last Fed presser said, I don't know whether I'm going to talk about big picture policy or whether it's going to be how the next few months will look.
It's a blank page. That's what we were told. It's a blank page. Well, I can tell you, that page has been filled with events ever since he spoke, and a lot of it is around what's happened at the long end of the curve. So much of this has got very, very ridiculous. There is a belief, almost consensus now on Wall Street, that he needs to be hawkish to cap the move at the long end and stabilise the 30-year bond and get in line with the Treasury Secretary, Scott Bessent.
The problem with that is, though, and if he's going to be hawkish and that being the thing that leads to the 30-year coming down, is it's not to say that inflation expectations have picked up. They've been quite steady. That doesn't seem to be the driver of the 30-year yield. In fact, globally, we have seen yields creep higher. So why would him being hawkish help the 30-year yield if it is a global phenomenon right now, not necessarily because of inflation?
Look what you're fighting. This headline just crossed from S&P. AI infrastructure investment to exceed $1.3 trillion by 2027. The numbers are massive. The amount of companies coming to market on the equity and the debt side, the competition for capital, explosive. How much can they influence that? How rate sensitive is that build out in this economy?
It also makes me think of when Treasury Secretary Scott Bessent came out and spoke about the buyback program. He spoke about these tech players. He said something along the degree of, I wish they would issue debt closer to the front end. I wish they would not be issuing this long-term debt.
Yes.
I don't think that's going to happen, though, because, again, the way that they are spending, these are long-term infrastructure projects, so they're issuing debt that is quite long-term.
It was funny to hear the Treasury Secretary recommend they issue through the belly of the curve. And that was a nice spot for them, potentially.
Yes.
It's a strange moment in this market. It's been a strange month. In the next day or so, we're going to hear from the man himself, Kevin Warsh, Fed chair in Jackson Hole, Wyoming. TK and Bramo already on the ground. The team have done a wonderful job framing just a beautiful shot in Jackson Hole. We'll catch up with Bramo in about 30 minutes' time. Coming up this hour, Savita Subramanian of Bank of America as equities climb on renewed AI hopes. Luria of D.A. Davidson as Nvidia sees sales surging into 28, and Nela Richardson of ADP as investors await a Fed signal from Jackson Hole. We begin this hour with stocks getting a boost from earnings from Nvidia. Savita Subramanian of Bank of America with a street low S&P target of 7,100, writing, the AI chip trade looks much better than it did at the beginning of the year. Software and semis have sold off, but are still seeing good revisions and some positive momentum. Savita joins us now for more. Savita, good morning.
Good morning.
Why is this index still so compromised, in your opinion?
Look, I think that there are still, problems that are creeping up in terms of earnings visibility. And I think we talked about this last time I was on. I mean, one of the things that we're looking at is just leverage, right? Leverage is probably the biggest driver of a higher equity risk premium. And what we've seen is leverage. I mean, we just heard, the opinions on whether they should issue on the short end or the long end. But these companies are raising capital mostly through debt, a little bit through equity. So I think that's where it gets a little bit murky. And then, it's ultimately the leverage picture doesn't necessarily sit on balance sheets. It sits in the footnotes of a lot of these companies. So it's hard to really tease out what the actual obligations are over time for the hyperscalers when they're not necessarily presented in the normal fashion.
The story's changed. We've talked about this. You've written about it extensively, and I've given you credit for that. The character of this market is so different. These companies have gone from big returners of capital to big issuers of debt. To see Alphabet go to negative free cash flow is a big line in the sand. It's a big change for this market.
It's a huge change. So I think that's the risk. I mean, what I like about tech versus communication services, the new media companies, is that they're a little bit cleaner at some level. Like, you know, for example, semis, hardware, memory, these are just CapEx takers primarily, although we're now starting to see some a little bit less transparency from some of these companies as well. So I think transparency is really the bottom line for what you want to buy right now. And what I like are companies that have delevered rather than are levering up. I think those are the companies that can really do well in this environment. And then when you look at cash flow versus earnings, there's a big gap in tech, in the hyperscalers, between what they're actually posting as earnings gains versus what they're posting, what they're actually generating in terms of cash flow. And I think part of that is earnings are carrying an undue proportion of investment gains. So if you mark to market your private investments, you look like you've made double the growth. And, you know, at some level, I don't know if investors are really teasing it all out when we look at S&P earnings and we say, this is awesome. I mean, earnings are great, but they're not as great as what they look like on that
So
bottom line.
for these hyperscalers at the moment are just riding that wave, and they're facing pricier input costs. The cost of capital is also going up too. What has to go right for them at this moment?
I mean, so far things have mostly gone right, and it's been a little bit eerie, which is why I think there's so much attention being paid to long rates, right? I mean, if equities, if debt is priced on the long end of the curve, you really need to keep that under control in order for this story to go on. And I think everybody wants this to go on, right? I mean, this is a wonderful thing. AI is fantastic. We want to see the U.S. really carry the torch here. But I think that, you know, in credit markets, things happen very slowly, and then they happen really quickly. And the bad stuff is usually, you know, kind of creeps up on you and then kind of punches you in the face. So what we found is that in a typical credit cycle, you've got a really long period of time between the lows and the midpoint of spreads. And then you've got like a fifth of that period in that arc higher. So I feel like this is just like waiting, watching. Things are getting a tiny bit worse, but things still look manageable. And what I worry about is any sort of shock to the system, which could come in a number of forms. It could come from consumers. It could come from hidden leverage risk. It could come from the private capital that's been extended over the years. So I think that's why we're a little bit more cautious on the multiple of the S&P.
It's hard, though, because timing the market is always incredibly difficult. And
yes,
then
it is.
the FOMO angst of watching everything rally while you're missing out because you're scared that the music will stop at one point. So what do you do in the meantime to make sure you can both capture the gains but also protect yourself in case of a downside?
Yeah. You don't want to be sitting in cash in these kinds of markets, especially if you've got inflation. You know, the real yield on cash is pretty low. So I think, you know, one of the indices or parts of the market that we've been writing the most about is large cap value. And I've just been saying this over and over again, and my whole team is sick of hearing me talk about it. But I feel like it's a beautiful story because you've got a lot of capital sitting in tech and cash when you look at retiree balance sheets, and they need inflation-protected income. They hold the lion's share of capital. We've got this aging demographic where folks are looking for inflation-protected income. And large cap value is one of the best places to be in an environment where inflation is rising. Maybe growth is accelerating, maybe it's slowing. Even during the 70s, large cap value massively outperformed bonds and growth stocks. So that's where I think we want to be. And what's interesting is we've seen this sort of stealth rally in the large value companies. So, you know, over the last 3 years, growth and value are neck and neck, despite what feels like the rhetoric is really, it's all been tech, it's been these mega caps, it's been these growth stocks. That's not actually the case. It's been a
More recently, financials. 11-week win and run.
Financials, some energy rallies. You've had a lot of different movement. And what's interesting is that whatever seems to fall into that value benchmark kind of catches a bid. And we're seeing that right now with some of the tech companies that are now valued.
Is it an AI trade still? I mentioned the 11-week win and run. It was snapped last week, by the way, but it was quite a streak for the financials. Yeah. Is that an AI trade as well?
I don't know what the narrative is around all of these sectors, but I think what we're seeing is just a pickup in cyclical growth, right? Which is something that nobody is used to because we haven't seen one since the early, mid-2000s. So I think that's what we're seeing is, and the long end of the curve is rising across the globe, as you rightly point out, perhaps for a good reason, which is that growth is getting better. So I think these are the areas where we see GDP-sensitive, dividend-yielding or cash-producing companies versus increasing leverage and hidden risks.
Savita, good to see you.
Nice
Always
to
is.
see you.
Thank you. Thanks for dropping by. Savita Subramanian there of Bank of America. Savita said it, others have too. You've got nominal GDP of 5 to 6% in this country right now. Risk appetite's buoyant. Every reason to suggest from a constructive perspective that yields should be higher.
Exactly. And that's why this idea of being hawkish maybe is a challenging one, that's not the reason that long end rates are higher. Growth looks really good. That supports this environment. And then also tech issuance and treasury issuance too. Things, again, that aren't really necessarily solved by hiking rates.
Nasdaq futures this morning up by 1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Nvidia shares higher in the pre-market. The AI giant topping earnings expectations and delivering that bullish sales outlook. Nvidia projecting to grow revenue by approximately 70% in fiscal 2028, nearly double what the street was expecting. At least 300 people now confirmed dead and 1,400 are missing at least after a flash flood devastated a Nepalese valley near the Chinese border. Geological assessments finding Wednesday's flood was caused by a collapsing glacier in the Himalayan region. Rescue efforts are underway. Kansas City Fed President Jeffrey Schmid speaking to Bloomberg, saying underlying demand pressures could justify a rate hike as soon as next month.
The last Q3, Q4 data for me last year was, I thought we certainly weren't restrictive and maybe even a little accommodative. So we've got work to do.
Schmid also rejecting the idea that a move at the October meeting is off the table due to the midterms. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. Up next, the morning calls, plus Luria of D.A. Davidson on Nvidia's bullish outlook for sales. What a revenue outlook they put out yesterday afternoon. Gil joins us next, live from New York City this morning. Good morning.
This is Nvidia trying to make a statement. We remain very, very bullish in terms of that content growth story going into the next 2 years. I'd say maybe the one you gotta have to maybe keep a little bit of an eye out on is kind of the financing structures out there.
Well, they certainly did that. They certainly made a statement. That was Angelo Zino of CFRA on Nvidia. The stock this morning in the pre-market, the biggest name on the planet, adding another 6 percentage points to that market cap. Nvidia advancing, going into the opening bell 1 hour and 15 minutes away. The price action more broadly, equity futures shaping up as follows. Off the back of that, on the S&P 500, higher by 0.5, on the Nasdaq 100, up by 1 percentage point. That's the price action. Let's get to your morning calls. That one stock in focus, Nvidia. Raymond James raising its price target to a street high, citing its projected growth demand and capital returns. Your second call from Bernstein, raising its price target, highlighting more data center upside and customer strength. And finally, JP Morgan raising its price target, citing accelerating data center growth. That name up by more than 6%. Shares surging in the pre-market as its outlook crushes expectations. The chipmaker forecasting 70% revenue growth into 28. Bloomberg's Ed Ludlow has more. Ed, where did that number come from last night?
Yeah, and Nvidia does not do this. They do not give full fiscal year guides. So this was a very deliberate and highly unusual move for them to make. 70% growth on the top line in fiscal 28 in dollar terms is $100 billion of upside relative to what the street thought, right? The street went into this modeling for about 45% growth in that fiscal year period. When I spoke to Colette Kress, Nvidia's CFO, we went round in circles quite some time on the idea this is a forecast modeled was supply. What Nvidia knows it can get its hands on. And actually, what Nvidia would argue, and maybe one reason the stock is up such as it is in the pre-market, is that there are parts of their business growing at 100%, or the demand is growing at 100%. But the supply chain situation is severe. Severe is the word that she used, John. And that, you know, they make a plea to the memory industry to increase capacity, get hold of more memory chips. And were it not for that allocation already being out there, it's done. There's nothing Nvidia can change about that. Then you might have seen that top line forecast grow higher. Nvidia will raise prices, by the way, starting at the beginning of next year, and that's notable. Confirms the Bloomberg reporting, but you know it's a lever that they can pull even as they guide that margins bottom out at the last 3 months of this fiscal year. As they ramp different generation of technology, but that's the impact. It is memory.
It is difficult to believe that number could be bigger. Ed Ludlow, Ed, thank you. Looking forward to the programme. Bloomberg Tech, a few hours away. Luria of D.A. Davidson maintaining a buy rating on the stock, a price target of 300, writing the highlight was Canada 27 guidance of 70% growth. They are saying they could do better if they had supply. Gil, welcome to the programme. I just want your initial reaction. You saw that number. You heard that number, 70%. The idea that it could be bigger. What was your reaction to that yesterday evening?
Yeah, NVIDIA, to Ed's point, NVIDIA has never guided out this far, not a specific guidance. So this tells you that the level of confidence they have in where we're going in the next 12 to 18 months is more than it's ever been. The stock should be up 25, 30% today. And I think investors are still hung up on law of large numbers. The numbers are so big that you can't possibly imagine they'll get bigger. And here we are. And they're going to grow 70%. And what's interesting about that is NVIDIA now, because we've had to raise our numbers so much, is trading at around 14 times earnings. So a lot of investors' portfolios right now are in stocks that are growing slower than that and are trading at much higher multiple. I think investors are going to start getting over this notion of law of large numbers and come back to NVIDIA because it is the center of this AI ecosystem. And clearly they have better visibility into next year than anybody thought.
Well, one of the reasons some had maybe looked and cast NVIDIA aside, at least in the margins, is the amount of spending they're doing and the concerns about circular financing, that they're essentially just financing their growth. The CFO, Colette Kress, had this moment on the call who said, the funding we're doing, the financing we're doing is for the supply chain in order to improve the supply picture, which would have pushed up our growth forecast to 100%. Gil, does that calm concerns about this type of financing that they're doing?
Yeah, they were very unapologetic about it. They're telling us, look, this AI ecosystem is developing very quickly, and we get a chance to invest in all these companies. We have so much cash, we generate so much cash, there's only so much we need to grow the business. We have an opportunity to invest in the ecosystem, help it develop, clear bottlenecks. And by the way, all these investments have paid off. We have gotten great returns on these investments. We will continue to make them to alleviate these bottlenecks, whether it's in memory or optical or equipment, fiber. They'll start investing soon in the energy infrastructure because that's going to be the bottleneck. And they even hinted at that yesterday. They are doing this because the more supply we have, the more we can serve demand with better models, which will make demand grow further, which will perpetuate the growth of AI. So they were very unapologetic about it. I'm not sure some investors are still hung up on it, but they were very unapologetic about the fact that they're investing in the ecosystem so it can continue to grow, because long-term that means more chips for them.
Well, in terms of demand and how they generate more of that, there was this interesting moment where Jensen Huang was asked about improvements in the model themselves and this idea that we might at some point get artificial general intelligence. Gil, if you believe in that future where we get AGI and machines are talking to each other, what does that mean for NVIDIA? What would pricing look like for them?
So the better the models get, the more useful they are to people, to consumers and businesses. So they'll buy more tokens. All AI models, open source, open weight, closed source, frontier, they all run on GPUs. So anything that helps make the models better will drive more demand for GPUs, by the way, and CPUs and memory. And what's important to note about this is that Anthropic is approaching its IPO. You better believe there's going to be a new exciting model that's going to come out during the roadshow. OpenAI is talking about approaching AGI. They're not going to want to fall behind. So all the models we're using increasingly now, we're already at over 100 billion run rate spend on AI for businesses and consumers. That's on older models that exist today, that are going to be introduced. So the models are going to get better. That's going to generate more demand. And again, any and all models in a data center, on-premise, on-device, they all run on a GPU.
Gil, just to take stock of things, as you look at things now, what do you think the biggest headwind to the build-out is? Is it memory? Is it energy? Is it capital? Increasingly, is it politics?
Well, right now it's politics, right? Until we get to the midterms, it's going to be a hot potato of nobody wants a data center. There's pushback because of the environmental implications, noise, pollution, not to mention the fact that the heads of the frontier models talked about creating unemployment. So there's a lot of backlash. Politicians will be running on that for the next 3 months. But realistically speaking, we are finding these new formulas where these companies, these data centers are such big projects. We're talking about projects that are in the tens of billions. So if you're doing a $50 billion project, and the municipality comes to you and says, we don't want this in our backyard, you can go back and say, you know what? We're going to put these Bloom energy units, no pollution, no noise. We're going to build you a new school. We're going to repave all of your roads. How about taking our data center? And I think a lot of municipalities are going to say yes to that. But we do have to get through the next 3 months where politicians are going to campaign against data centers. What happens afterwards is again, will be municipality by municipality. But for the next 3 months, that could slow progress down in some places.
Gil, thank you. It's good to see you. Gil Luria of D.A. Davidson, thank you, sir. Nvidia in the pre-market higher by 6.5%. Do those problems go away after the midterms, or do they get worse going into 28?
It's hard to see them going away, and I think it's just because it's like the physical manifestation of everything people are worried about right now, about the environment, about what it's doing to that. Are they going to lose their jobs? And to see a big, clunky, and loud data center, I think in their mind, even if it's bringing them benefits in the long term, it's hard to escape the disappointment they feel about that. And for politicians, it's been a winning campaign message.
The messaging from the industry has been pretty awful, and it's catching up with them going into the politics. Just on Nvidia, where did that guide come from? Who was that guide for? Do you think it was for Wall Street, or was it for the industry? To the memory makers, like, get building. The demand's there.
I think that is a clear part of it. And will that encourage them? I mean, the memory makers have complained before about their big customers like Apple saying, when the memory cycle turns, you weren't willing to pay us more. And that's why we didn't invest. And that's why we're in the position we are now. So if Nvidia can come out and say, look, this is going to last for some time and you can continue to get paid, you need to build more, maybe this will finally convince them to do just that and invest.
Stock is higher in the pre-market by 6.5%. Up next, we'll get you some data. The last read of the jobs market heading into Jackson Hole, Wyoming, and that speech from Kevin Warsh. Breaking jobless claims just around the corner. Nela Richardson of ADP will break it down. We'll catch up with Mike McKee on what he's seeing in the data. Bramo's going to stop by as well. She's in Jackson Hole. She'll give us a preview of what to expect over the next 24 hours. From New York City, with equity futures positive by a few tenths of 1% on the S&P, on the Nasdaq higher by close to 1%. Jobless claims data just seconds away. The estimate in our survey, 208. Previous week, 206. We're hanging on to those levels all the time, every time we get this print. Let's see what we get in a few moments' time. Equity futures right now in the S&P 500 up by 0.4 into that jobs data. Nasdaq 100 futures high by 1%. In the bond market, 2s, 10s and 30s. Yields look like this, creeping higher throughout much of this morning, up by a basis point or two at the long end, 518 on 30s. With your jobs data, your weekly jobless claims just crossing. Mike McKee has more. Good morning, Mike.
Good morning, John. Well, if you are a hawk like Jeff Schmid and want to raise rates, the labor market is not a problem. 203,000 jobless claims filed last week after a revised 207,000 the week before. The continuing claims number, 1,778,000, drops from 1,796,000. So the labor market hasn't changed at all in terms of people losing their jobs. The numbers are just about the same as they have been. One other number out today is the advanced goods trade balance. It's the first half of the trade numbers we should get next week, $101.5 billion, which is almost exactly, $118.8 billion, which is above the $101.4 billion that we saw the month before. So that's a subtraction from growth going forward. And that's basically all the economic news that we have here for these people to discuss. But the jobless numbers tell us, John, that basically there's nothing changed in that argument, and they can focus on inflation.
Let's give Mike McKee his opportunity. Give him his wide shot. Mike McKee, tell us what you see. How beautiful is it there? What's the temperature like right now?
Temperature's not too bad. It's a little warmer than it has been, probably in the high 40s. So Lisa and I were debating whether it's global warming or not. But yeah, the sun is just coming up, and you can see the Teton Mountains, the Grand Teton right there behind us, and it is absolutely beautiful. There's a cloud behind them this morning, and you just can't make this stuff up.
It's
Everybody
gorgeous.
who arrives here says the same thing. Wow, it's real.
Mike McKee, thank you, buddy. Team does a fantastic job every year of framing that beautiful picture. I can tell you in real life, feels like a green screen right now looking at it, Danny. Right. In real life, it looks like a green screen too. When you stand there and look at it, it's just amazing to see.
Until wildlife gets a little too close to you for comfort. That must happen, right?
Yeah, Bramo likes the bear stuff. I can't stand it. I'm petrified of them, as you should be.
Yeah.
Yeah, as you should be. I have great respect.
They're vicious creatures, yeah.
They can be if you get in their way, without a doubt. Mike, thank you, buddy. Appreciate it. Bramo moments away. Let's catch up with Nela Richardson of ADP on this data. Nela, we can stay in bed and just pre-record this segment. Jobless claims never move. Claims right now at 203. The previous read was, what, 207? The estimate was 208. Nela, what do you see beneath the surface? How much churn have you seen in this labour market?
No, it is a very still labor market. And good morning, Jonathan and Danny. It's very still, but underneath there is churn. We're seeing people leave the labor market, and that's why the unemployment rate has gone down. We're seeing not only that, but there is this AI effect for younger workers, and it's been hard in some AI-exposed fields for them to get jobs. We're looking at wages and whether they're keeping up not just with current inflation, which is still too high, but cumulative inflation over the last 5 years. So there's stuff going on. And you know, when we look back at the last jobs report, 23,000 decline shows you that there is this, we can't take this labor market for granted. It's still a vital player that we have to pay attention to in the fullness of monetary policy.
Nela, what does that mean in terms of what you want to hear from Chair Warsh? Do you need to hear him acknowledge some of the concerns around this labor market?
You know, I think the Fed, and Warsh in particular as the new chairman, is in a really interesting situation. When things are totally bad, it's so easy to define yourself as a member of the FOMC. And when things are really good, you don't really need the definition. But the truth of the matter is the Fed is in this muddled middle. We are literally splitting hairs on inflation as market watchers. And around the world, every major central bank is doing something different when it comes to their monetary policy. You've seen that with the ECB, you've seen that with the Bank of Japan, you've seen that with Brazil, going their own way. This divergence is real. So how do you step into that and define a moment that is different and changing and evolving? It's difficult. So I guess I'd like to see an attempt, but it's going to be a challenge, not just for Warsh, but for every central bank chairman, because there's no global event to respond to. It's localized inflation that they have to combat.
Nela, it's localized, but having higher, longer end yields is something that the globe is dealing with. It's not just the United States. In that view, is it really the task of Chairman Warsh to give something more localized when indeed this is a global phenomenon happening right now? Is this something he singularly can fix by just sounding hawkish?
I wish, and I think you've hit on the point. It's not easy being in this position. It's not easy when every major economy is experiencing inflation differently, where the Bank of Japan is seeing something unprecedented, where the ECB recently hiked in June. It's not easy being in this position where some emerging market countries are considering a rate cut, not a rate hike. And how patient can the patients be? So I think there is a lot of narratives and storytelling going on. And in some sense, Warsh gets to pick his favorite story and lean in, but a story has to be told, and that's going to be the challenge.
Nela, enjoy the mountains. No doubt we'll catch up with you again in the next 24 hours or so. Nela Richardson there of ABP, who I believe is also in Jackson Hole based on that shot going into tomorrow. He can make it worse, but he'll struggle to make it better. Isn't that a problem? That's a big problem. You're between a rock and a hard place over at the Fed.
And I've said this before, but there's no roadmap for restoring credibility. It's not like there's a clear path that anyone has laid out for him in order to do that. And if you restore credibility, again, by sounding really hawkish and not giving forward guidance, but giving something that sounds like you might hike, what if that's a policy error? What if that's a mistake? How do you weigh those two things?
Bramo Nirvana right now. Lisa in Jackson Hole, Wyoming. Lisa, could it be any better for you? Fantastic backdrop. She loves to hike, loves to talk about monetary policy, and now monetary policy might have to consider the deficit. Lisa, does it get any better than that?
No, this is pretty awesome. And I have to say, you and Danny were talking about the difficulties of wildlife. And yesterday, our car got stuck because there was a herd of buffalo crossing the street, and I couldn't have been happier. But, John, this is a really notable moment because there is a difficult understanding of whether they've made progress or fallen further behind since the last FOMC meeting. A year ago, the Fed funds rate was at 4.5%. We were talking about how potentially there could be weakness in the labor market. The unemployment rate's gone from 4.3% to 4.1%. Inflation has gone from 2.9% to 3.3 or 3.4%, depending on which metric you look at. Either way, when you cut it, when you take a step back, they have gotten further away from their mandate. So yes, Fed Chair Kevin Warsh has a very difficult situation where he could just make things worse. But a lot of people feel like things have gotten worse since the last FOMC meeting. And when you take a look at a vacuum, they've gotten further away from their price stability goal at the same time that the employment mandate doesn't seem to be a problem. And this is the reason why you hear an increasing number of Fed officials coming out and saying, ultimately, this is a time where you have to think maybe we are accommodative rather than restrictive, and maybe we have to change that.
Lisa, they can make things worse. Can they make them better? How much influence do they have over the sources of inflation that we see and talk about every day?
That's the difficult aspect. How much control can raising rates have on lowering the price of oil without entirely torpedoing the economy in a punitive way? How much can they affect tariff rates? How much can they affect artificial intelligence spending after what we heard with all the forward orders for Nvidia? It's unclear that they can. In fact, many people say it is not likely that they have any control whatsoever, which is the reason why, and I know that a lot of people are rolling their eyes every time they hear the word task force. I actually am interested in hearing how they measure inflation, how they measure employment, how they measure a very new economy to understand whether inflation's getting away from them. Just in a vacuum, looking at these numbers, you would say, yes, inflation's getting away from them. But then you layer on the war in Iran. Then you layer on tariffs. Then you layer on all of the AI spending and the robust capital markets. The only aspect they could influence would be the robust capital market side of things. So does torpedoing capital markets really get them anywhere when it comes to their dual mandate? Do they still have a dual mandate? I mean, it is a very difficult moment. Kevin Warsh might be taking this opportunity to say nothing. But if he says nothing, that too will be speaking volumes given how the bond market has moved. So right now, this is a momentous Jackson Hole, not only because it's beautiful and I love hiking and I love all of the animals that I should probably be scared of, but nonetheless, I do think that it is going to be a pivotal moment where they look forward and sort of redefine their role in a kind of muddled economy.
Lisa, though, is there any sense that this is a chair who wants to look backwards, that wants to take this to pre-2008 type Jackson Hole, where you just talk about big picture things moving forward, that it becomes more of an academic exercise, which has always been at the heart of Jackson Hole? Is there a risk that this is a Fed chair who tries to turn back time and have Jackson Hole look a bit more like it did in the past?
If he's doing that by virtue of the topic of this meeting, well, I don't think it's going to fly because they're going to be talking about stablecoin ostensibly at this meeting and some of the new financial innovations for payments. I don't think anyone in the hallways are talking about financial innovation when it comes to the payment system. They're talking about inflation. They're talking about potential political pressures. They're talking about a new Kevin Warsh. And they're talking about how to combat inflation in this very new way. That said, to your point, Danny, going back to an Alan Greenspan type of Federal Reserve that is sort of seems like one of the goals. And Alan Greenspan himself, that was the era when they established the 2% target for inflation. Do you revisit that? Do you start to pull back from that type of specific targeting is a really key question. And Danny, a lot of people would say, look, this is a neat way to politically extricate yourself away from the ire of President Trump. But a lot of people in markets are talking about how it actually is a good time to ask questions, like whether the Phillips curve still works, about what the goal of inflation targeting actually is, about how we measure things at a time where a lot of the surveys that we get on a regular basis are seeing the participation rate in those surveys go down. I mean, Jonathan Ferro still has not gotten a call from the University of Michigan when they ask how you feel and what you expect inflation to be. So it gives you a sense of just how small the sample size really is.
You know what I'd tell them? 25%. 25% over the next 3 years. That would be my call. That's what I'd say. If you, Mitch, ever called you, survey of 500 people, 600 people.
Oh, you mean to completely skew the sample size?
Yeah, totally.
Yeah.
No, not deliberately, Danny. That's just how I feel.
Of course, yeah.
Bramo, before you go, important question. I spoke to TK on the runway of LaGuardia yesterday. He was on the plane. I was a bit worried about him. The flight attendant was shouting at him to get off the phone, so we hung up pretty quickly. I haven't heard from him since. Did he make it okay?
He did. He actually stumbled in this morning, was hiding in the doorway to avoid getting in Michael McKee's shot. But he is here, and he is in rare form. He is very excited. I think that he was here last night having drinks with Catherine Mann and getting all sorts of inside intel. So you can look forward to hearing all about it.
That makes sense. Bramo, thank you. The Blue Heron Lounge opens at the Jackson Lake Lodge, I believe, at 11 a.m. Eastern Time. So a few hours away, Danny. So
I'm sorry, like
TK
the bar?
can get his beverage of choice.
The bar opens at 11 a.m.?
The bar opens at 11, yeah. Cocktails and light fare.
Ah.
OK. Cocktails and light fare.
If you're going to be discussing stablecoin, you maybe need one or two of those.
Let's hope he doesn't talk about stablecoin tomorrow. That would just be a shocker. Honestly, I'd be so upset for the whole of the team going out there just to hear that speech.
Yeah, but wouldn't that be a market signal in itself?
Oh, without a doubt, yeah.
That itself, I think, would be increasingly fascinating.
We do not care.
Yes,
that
correct.
would be the signal from that.
Yes.
Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Recapping the data we just got, jobless claims falling from a week ago, coming in at 203,000. That was below the estimate for 208,000. And continuing claims, the proxy for the number of people receiving benefits, falling to 1.78 million the previous week. Shares of Salesforce surging in the pre-market, the software giant delivering an outlook for strong revenue expansion. Salesforce also announcing an expanded partnership with Anthropic, integrating its products within the AI model Claude. The Trump administration is reportedly considering another round of semiconductor tariffs. According to Politico, the new levies would expand beyond just chips to include the products made with them, like laptops, gaming consoles, or data center servers. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Michelle Weaver of Morgan Stanley as Nvidia re-energizes the AI trade. Live from New York City this morning. Good morning. You're watching Bloomberg TV.
AI has been an earnings momentum freight train that just has not stopped. We've been overweight tech. Yes, the valuations are a little rich, but when the earnings are growing this fast, they deserve it. The stock market is just taking in so much capital. It's not like I'm saying out of stocks, but I'm saying incremental dollar. Some of these bonds look pretty attractive.
That was Matt Miskin of John Hancock weighing in on this bond market. Yields have been creeping higher this month, though stable, particularly at the long end, given the verbal intervention from the Treasury Secretary Scott Bessent in the last week or so. The equity price action right now on the stock side of things looks like this. Equity futures fading just a little bit going into the cash open. We're higher by 0.28% on the S&P, on the Nasdaq higher by 0.8, with some single names and morning movers. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Well, I thought I'd take a look at some non-AI complex names. So we'll begin with Moderna. As you can see, the stock down about 4%. It's been pretty volatile and a huge week, it has to be said, for Moderna. It was only yesterday, a week ago, that it got positive results from its cancer vaccine trial, and that sent the stock up 177% that day. Well, it's down about 25% since then in fits and starts. Today, the story is dilution. It's going to obviously take advantage of its massive price increase to issue some convertible notes, $2 billion worth with the option to issue $300 million more. Investors not too bothered, right? So they're improving their balance sheet on the one hand, a little bit of dilution on the other, but they've had a good ride, so those shares are well off their lows of the day. Now, let's take a look at some retailers. It is definitely a tale of $2 here. You've the Dollar Tree stores down 6.5%, Dollar General up by about the same amount. Now, the difference here is that Dollar Tree is much smaller than Dollar General, which is about twice the size. In fact, has twice as many stores. It says people are coming in and they're spending more people spending more. Here, we're looking at higher priced items, but not as many people coming into the stores. Either way, there are potential fragilities there for the consumer. You can see the stocks are getting rewarded in different ways, but there's definitely a lot to be learned from looking at these two earnings. And then let's take a look at Best Buy, because there it was a pretty rosy picture for the consumer. Now, yes, the stock is down about 6%. If there were any fragilities here, it could be international sales, which missed a little bit, or perhaps marketing expenses. But generally, everything was fantastic for Best Buy. In fact, it was one of their best quarters since just post-COVID. Everything sold more. Computers saw a surge in sales. TVs up 10% in the quarter. And then who knew? Collectibles, trading cards, John, had an excellent performer at quarter at Best Buy as well. And it is Corey Barry's last quarter as CEO. Bear in mind the stock is up 30%, so that could be another reason for some profit taking.
I can't say I was part of that. Anyway, Vonnie, thank you.
You didn't want the Topps $50 mega football cards, no?
I don't think, maybe when I was a kid, those Panini stickers. Not the trading cards, though.
Yeah,
you into trading cards?
Me into trading cards? I had like maybe 2 Pokemon cards because I felt the social pressure of it, but that was it. Yeah.
Back in the day. Okay, let's talk about Nvidia. Robust outlook from that company, lifting tech stocks, breathing new life into the AI trade this morning. Michelle Weaver of Morgan Stanley writes in, the pullback in AI infrastructure and related sub-themes since late June has provided a better entry point to a strong secular theme. Michelle joins us now for more. Michelle, good morning.
Good morning. Thanks.
I don't expect you to drill down on a single name, but that revenue outlook from that one company, wow.
Incredible. 70% revenue growth in 2028 off of 45% before. So we're seeing full demand for AI compute. There was a lot of questions, I think, this summer around the violent momentum unwind we had, and is the AI trade still on? And I think Nvidia's earnings prove that, yes, we're still seeing incredibly voracious demand for compute.
The multiple on that name has been held back.
Yes.
In fact, it's really underperformed the rest of the chip sector. What do you think is behind some of that?
I think there's just concern of how long can this momentum go on for? Are we going to start to see a peaking in demand? If I zoom out too, I think another big question has been, are enterprises going to really continue to spend on compute? There was a lot of fears around the end of spending on tokens, token maxing. But if we pull back and look at what the median user at an enterprise spends on tokens, it's only $11 per month. So it's still very in check for the typical user at an enterprise.
And those costs of what they're spending have been plummeting if you look at the data on compute prices. And part of that is their move to open sourcing. So you have a product that is essentially deflating, but the inputs going into building that product are getting more expensive because of scarcity, plus the cost of funding it and financing it has gotten more expensive too. In order for this ecosystem to work, does everything just need to go perfectly?
You need to see volume continue to hold up. And so even if pricing falls, if volume continues to increase, then yes, the story can hold up. And I think what's really important is you have to look at the ultimate diffusion of the story. What does the user see? And so we're starting to see really positive signs for the AI adopters. We're seeing for companies in the S&P 500, 25% of them are now quantifying the benefit they're seeing from AI adoption. That's up from 14% a year ago. We did another analysis and found 50 basis points of relative forward net margin expansion for AI adopters. So you're starting to see this come into the fundamentals.
So are we comfortably then just out of the experimentation phase? Like it is here, it is being adopted, and it is creating real profitability?
Yes. So we're fairly early on in the S-curve, and our tech team does a great CIO survey. They expect by the end of this year, the majority of companies will have at least one AI tool live and in production. So we are, like you said, moving out of that test experimentation phase into the live production phase.
Michelle, benefits. you got a shout out from Dan Skelly on the programme in the last 24 hours. Which industries are seeing the biggest benefits?
Financials are one that really stand out. Tech companies, communication services stand out as well. But financials, if you think about it, it's a very regulated industry. The data is very well suited for this type of analysis. There is a lot of back office type functions that you can make a lot more efficient with this.
Are we about to see the job cuts anytime soon in that industry?
What we're seeing right now, and we've done a lot of survey work on this, is you're seeing just less replacement of attrition. You're seeing lower hiring growth, but we haven't seen anything concerning. We haven't seen any big pullbacks in jobs numbers.
How do you think the software makers are standing at this point? We're months away of the SaaS apocalypse, the concern over them. A lot of them have tried to pivot. Salesforce, an example of strong earnings, adopting AI. Have they been able to adopt, or have we not really seen the drop off yet? That these things tend to be sticky, and eventually maybe software does face a reckoning over AI's implications.
Yeah, so we saw huge problems within software earlier in this year, but that has turned around quite a bit the last couple of weeks, and I think that's because people are realizing you need an application layer. These models are great, but businesses ultimately have to deploy them, and you need to be able to have the end user able to interact with these models, and software can help build out some of those tools.
Do you see a world, Michelle, there where hyperscalers, hardware and software can perform simultaneously in this stock market?
Simultaneously, perhaps. I do think that there's room for upside for all of those different pockets. Is everything going to go perfectly for all of them at once? I think that's very tough to say, but there is absolutely room for them to perform.
Michelle, it's good to see you. Thanks for being here. Michelle Weaver there of Morgan Stanley. Just a major number coming out of the biggest company on the planet, which is just about unthinkable. If you really take a step back, remember we used to talk about China. China's getting so big, they just won't put up the same kind of growth numbers. You just can't, right? The law of big numbers. Here we are talking about the biggest company on the planet forecasting revenue growth of 70%. Don't lose sight of that this morning. That's ridiculous.
And the idea that that doesn't even fully capture what the demand is, that
could
70%, yes, it could be 100 that's supply constrained. And more things could add to that, more companies adopting this, using open source. Do we get AGI into the demand even explode from there? So this kind of feels like for them setting almost a benchmark that's lower to say that we can even beat this if supply keeps up and these models improve.
I will say there was a time when you beat expectations by that much that this stock would have been up a lot more than it's up this morning. That's the one to watch going into the opening bell when you guide us through the cash open in 40 minutes' time.
Yeah, it's going to be all Nvidia today. That is going to be such a huge driver for this market. And will that win out over the pressure of yields? And if yields win out, then maybe this market has a problem.
Tomorrow, it's going to all be about Kevin Warsh. Kevin Warsh, Fed chair in Jackson Hole, Wyoming, for his first annual get-together as the Fed chief, with the pressure building on the Fed chair following the news conference just a month or so ago. A credibility question? I don't know. But the Treasury Secretary is unhappy with where yields are in this bond market. Does he have a role to play in fixed income? That's a big question for the team out in Jackson Hole. TK Bramo, Mike McKee and everybody else on the ground, bringing you live coverage and programming at 9 a.m. Eastern Time tomorrow morning. Tomorrow, we'll catch up with Peter Cheer of Academy Securities, Priya Misra of JP Morgan, Subhadra Jafra of SocGen and Mark Cabana of Bank of America. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.